Alright guys, hi. So welcome to PKSIR classes. This is me, Prasanna Kumar, PKSIR over here. Now, this is a very important session, Anna. So we're gonna revise Ind AS 115, one of the most important Ind AS in your syllabus as well as lengthiest. Some people even feel that it is the most difficult Ind AS. Now, difficulty, it is a perspective thing. People who are not really comfortable with theory-dominated Ind AS, obviously they'll find this very difficult. Anyways, for others, it's a kind of decent standard. Now, what we're going to do in this particular session is absolutely we're going to go with a fast-paced revision. So this is a revision session, Anna. So usually when I go with regular classes or exam-oriented sessions, I'll be going with a lot of logics. Now here, I will not have that much of time to cover logics because our intention is to revise the concepts as early as possible. Okay, you got it? Right. Having said that, let's start with the standard. So what do we have? Revenue from contracts with customers. So basically it's a revenue standard. So this standard tells you when to recognize the revenue. It's as simple as that. So you get money from the customer. Just because you got money from the customer for the good that you have sold or the service that you have provided, immediately you can't recognize the revenue. So Ind AS 115 says, just wait, I'll tell you when to recognize revenue, how much to recognize revenue, everything. So two questions will be answered by Ind AS 115 predominantly. One, when to recognize the revenue. Should you recognize today or after 6 months or after 1 year or on an average over the year or at a point of time? At the same time, how much you should recognize, that also Ind AS 115 will say. To put it very simple, this is all the standard is all about. Okay. Now, if you look at the scope of the standard, obviously it will not apply to leases, Ind AS 116, insurance contract 104, financial instruments, and non-monetary exchanges between entities in the same business. There is one point that you need to focus. Rest of the things is very easy to remember. 116, this will not apply. 104, it will not apply. 109, it will not apply. So pretty easy to remember. This is not that important. So let's get into the core principle of Ind AS 115. Now, if you look at this, I've highlighted revenue should reflect the transfer of control of goods or services to the customer. That is the core idea of this particular standard 115. Sir, what do you mean by this, sir? Very simple, Anna. There is something called Holy Trinity, which I usually call. You're going to learn something called performance obligation very sooner. And that performance obligation, as of now, you don't know what is performance obligation. Just remember, okay, performance obligations, based on this, we will go for something called transfer of control. And based on that, revenue recognition will happen. So there are three keywords that you have to remember throughout this standard. Performance obligation, transfer of control of goods or services, revenue recognition. There ends the matter. Just remember this. When time comes, I'll ask you to sync it. You'll automatically sync. Anyways. See, the core idea of this particular standard is that usually what we feel, because we are done with contract acts and so many other, where always the focus on these two words. When there is a transfer of risk and rewards, you generally recognize revenue. This is what we have seen it in so many other cases, right? But that is not the case when it comes to Ind AS 115. Ind AS 115 takes a totally different approach. It tells you, forget about risk and rewards. Okay, because that's your usual thought process. Come to something different. What is that? Focus on transfer of control. You see the situation, you analyze the situation of the transaction happening between the customer and the entity. You focus on the area of control. When the control is getting transferred, whether you are providing good or you are providing service, that doesn't matter. When the control is getting transferred, these are all the keywords, Nana. This you have to repeat it as it in the examination to get the marks eventually. Okay, so transfer of control of goods or services, based on that only we'll be recognizing the revenue. Not based on risk transferred, not based on reward transferred. Usually we got used to listening these words, risk and reward, risk and reward, risk and reward, but that's not the case over here. Transfer of control of goods and services. So hence an entity should recognize in a manner that depicts the transfer of goods or services to the customer and the amount that reflects the consideration, means how much money you have got. That also Ind AS 115 will say. So two things are focusing over here. I mean, Ind AS 115 is focusing over here. One is transfer of control of goods and services. Other sorry. Transfer of goods or services to the customer. For example, today itself you are transferring a good. For example, this good is there. Today it is transferred. Now. So transfer of control has happened. Recognize the revenue. Okay, I am giving some service, like for example, subscription service for your internet. So how am I transferring the control of the service? This month something, next month, like that over a period of time. Every month you will be receiving service now, which means as an entity, I'll be giving you service. So in that case, over a period of 12 months, you need to recognize the revenue, because the transfer of control is happening over a period of time. You understand the point? Whereas, for example, you're just buying this particular remote from me. I just give you this remote, you buy it. Transfer of control is happening at a point of time. Right now it's happening. Therefore, recognize the revenue. It's as simple as that. The other question is how much consideration. So for this transfer of revenue, transfer of control, when it is happening, how much money I'm getting, that will be recognized as revenue. This is the basic idea. Okay. So look at the simplified understanding. Revenue is not recognized when goods are produced or billed, but when the customer obtains control over these goods or services, meaning customer can direct their use and enjoy their benefits. So another point that you guys need to focus is, sir, you're using the word transfer of control. Transfer of control. Okay, transfer of control means what? When can I say that a good or a service is transferred to the customer? Transfer of control has happened to the customer. Very simple. Look at the customer and see whether he is able to enjoy those services, if it is a service, or he is able to enjoy those goods. If he is able to do that, or he is able to control the use of those goods or services, or direct others how to use those goods or services, if any of these things are happening, it means that you need to understand that transfer of control did happen. Clear? So you have to look into the customer to understand whether transfer of control did happen or not. Clear? That's the basic idea. All right, look at the example, you'll get better clarity. Suppose a car manufacturer sells a car to the dealer. Okay, they have signed the contract and all that. The moment they have signed the contract, can I say the transfer of control did happen? No. When the car is actually delivered and the dealer can sell it, it's not like he has sold it, but he's in a position to sell it, which means dealer is the customer over here. Can customer use the good? Yes. Only if he gets the good, then only he'll be in a position to use the good. In that case, transfer of control did happen. Okay. Merely signing a sales contract or receiving an advance does not mean revenue recognition. Transfer of control should happen. Transfer of control should happen means what? You look at the customer, you see whether he's able to enjoy the services or he's able to direct the use of the good. In this case, he is able to direct the use of the car which he has got from the company as a dealer. What do you mean by directing the use? He is able to sell it. That's his wish. So if he is able to do that, then transfer of control did happen. Then you start recognizing the revenue. Not with respect to transfer of risk and rewards and all those things. Forget about those terms. So this is the first basic thing that you need to get into your mind. Is this clear? Right. Now, before we get into the core of this particular standard, let's get the basic idea of the standard. Alright, Nana. See here, Jio is providing broadband services. Okay. On day one itself, they are charging 12,000 for the entire year. Jio is taking that much of money, which means as a customer, you are paying in advance. Now for this, Jio is providing 1 year of internet service, as well as he is also providing router as free. Okay. But if you look at the standalone selling price, which means if you want to buy internet subscription for 1 year separately, it will cost you 18,000. If you want to buy router separately, it will cost you 6,000. That's what we call standalone selling price. But whereas here, you're getting it put together for 12,000. You got the point? In that case, what Ind AS says is that you do one thing. Allocate this 12,000 which you have received from the customer in the ratio of standalone selling price, that is individual selling price. Okay. If you allocate that in the ratio, you get 9,000 for internet, 3,000 for router. Now apply the logic which I have told you. Transfer of control. You guys remember here that we have discussed transfer of control. Now, in case of internet, transfer of control when it is happening over a period of time, because it's a service. Now, first month some service is done, so transfer of control happens. Next month, next month, next month, next month, like that it will happen over a period of 12 months. Whereas when it comes to router, it happens now itself at a point of time. Immediately router is given and then the job is done. So therefore, with respect to router, transfer of control already happened. So which means you can recognize revenue, which means 3,000 I can recognize today itself. Whereas 9,000 I need to recognize over a period of 12 months, which means 9,000 divided by 12. But today ultimately you have received 12,000 from the customer. You got the point? So bank account debit 12,000. To revenue, can I write 12,000? No, you should not write 12,000. Why? Because check the transfer of control. Okay, transfer of control with respect to router, it did happen. It went to the hands of what? The customer. So therefore, with respect to 3,000, recognize the revenue today. With respect to 9,000, you have to recognize over a period of 12 months. So therefore, today I'll recognize that as advanced revenue divided by 12. Every month, that much I'll recognize, because that much every month transfer of control happens. So look at this entry. Bank account debit, you received 12,000 from the customer. Advance to revenue 3,000, because for this transfer of control did happen at a point of time. And with respect to this 9,000, transfer of control yet to happen. It happens over a period of time for the entire 12 months. Therefore, find out how much is per month. 750 at the beginning on day one. Still service for internet did not start. Therefore, transfer of control of service did not happen. Therefore, entire 9,000 will be treated as advanced revenue. 1 month gone. Now for 1 month you provided service, 1 month transfer of control did happen. To that extent of 1 month you can recognize 750. So advance revenue will be debited, revenue will be recognized. Same entry will repeat for a period of 12 months. Now 1 month is done, for another 11 months it will repeat. Clear? Did you get clarity? Now this is just a rough idea. We did not get into all those 5 steps and stuff like that right now, just to give you a basic idea. So the problem with this standard is, without examples you will not understand this standard, or it will be very difficult to understand. That's why we have to go with examples. If you just read English sentences, this standard is very difficult to understand. Okay, and it is revision session, so I have to maintain some pace so that we can cover more in less number of hours, so that it will be helpful for you when revising the day before the exam. Anyways, now come to the core of the standard. The core of the standard is, revenue recognition, when to recognize the revenue. As of now, we have just learned 2 basic things. You need to focus on transfer of control. Correct? If transfer of control did happen, accordingly, you need to recognize the revenue. That's what we have learned so far, nothing else. Do not focus on risk and rewards, right? Now, coming on to 5-step model, we have got 5 steps. Once step 5 is finished, then we will know when to recognize the revenue, how much to recognize the revenue as well. So, what are those 5 steps? Identify the contract with customer, identify performance obligation, determine the transaction price, allocate the transaction price to the performance obligation, recognize revenue as and when the entity satisfies the PO. It's very easy to remember. Otherwise, if you want mnemonics, you can just follow this: CPTAR, contract performance transaction allocation recognition. Although I don't recommend this, just remember, it's pretty easy. First, you need to identify whether there is a contract with the customer or not. Okay, there is a valid contract between customer and the entity. Okay, now find out how many promises each has made to each other. This guy will promise something. Entity will promise that I'll give you this, I'll give you this. Customer also will promise that I'll give you this much money, that, this and all. So identify the promises, which is nothing but we call it as performance obligations. Okay. Generally, we'll see it from entity's behalf, not on the behalf of the customer. Why? Because we are the entity. Entity only will do revenue recognition. So you need to think from the point of view of what? Entity, not from the point of view of the customer. It's as simple as that. Third point is, okay, now you have identified the performance obligation. Now find out the transaction price, which is actually the most difficult step out of these 5 steps. And it will take a lot of time as well when we revise as well. Which one? Step number 3. So out of all the 5 steps, step number 3 is the most important as well as complicated step. That is determining the transaction price. Transaction price is nothing but the consideration that you receive from the customer as an entity. Okay. Now in that there are so many variabilities. Fixed consideration will be there, variable consideration will be there, uncertainty will be there. Sometimes customer will give something to the entity. That there's a lot of complications are there. Out of all these complications, we need to work together, and then eventually we need to find the transaction price. Now step 4 is very easy, matching these two, step 2 and step 3. Sir, what do you mean by matching step 2 and step 3? In step 2, you have got promises, performance obligations. In step 3, you have got wholesale transaction price. Now multiple POs will be there in step 2, and this transaction price must be allocated to each PO. That's what you do in step 4. And now once you know, for this PO, this much is transaction price. For this PO, this much is transaction price. For this PO, this much is transaction price. You wait for the PO to happen. PO did happen, recognize the transaction price as revenue. Another PO did happen, how much transaction price already you have calculated in step 4, that much you recognize as revenue. Another PO did happen, finished, recognize the revenue. Here you can ask me, sir, just now you have told that transfer of control should be the base for me to recognize the revenue. That's where the Holy Trinity comes into picture. The moment PO is satisfied, it means that transfer of control did happen. Therefore, revenue should be recognized. Are you able to understand? This is where many students gets confused. So again, I repeat, just now you have told, sir, that transfer of control did happen, then you have to recognize the revenue. Now you are talking about linking PO with transfer price, with transaction price. The point is, once you are done with PO, which means once a performance obligation is satisfied, automatically transfer of control did happen, which means revenue will be recognized. So the first step is performance obligation getting satisfied. If this is satisfied, then transfer of control did happen. If this happened, then revenue has to be recognized, which we'll be doing in step 5. So basically, just first 3 steps you need to remember. Step 4 is a link between step 2 and step 3. Step 5 is waiting for performance obligation to happen and then start recognizing the revenue, which you have already calculated in step 4. So basically 3 steps only. So now it's very easy to remember once you know the flow. Now tell me, is there a contract between the customer and the entity? Right. Then identify the promises. Okay. Identify the transaction price. Okay. Match the number of promises with the transaction price. For this promise, this transaction price. For this promise, this much transaction price. And then you wait for the promises to do happen. And then once the promise is done, performance obligation is done, transfer of control did happen, recognize the revenue. 5 steps are done. Clear? Everybody? Now I have a complete picture. Now let's go one by one. So we'll start with step 1. Remember, Out of all these 5 steps, the most difficult, most time taking, and most important is step 3. What is that? Determining the transaction price. Accordingly, we'll focus more time on that. Remaining or relatively easier to understand. Anyways, let's start with step 1. Least important is step 1 only. Least important is step 1. Chalo. Alright, Anna. Let's focus on this. So first of all, there should be a valid contract between the customer and the entity. This is the least important step. So we'll just go with one example. Okay. Totally, we need to have 5 conditions that need to be satisfied to satisfy step 1. Okay. Approval and commitment must be there between the entity and the customer. Identifiable rights should be there in that particular contract, which means what the customer will receive from the entity, what the entity will deliver. That must be clean. Then you have identifiable payment terms. How are you going to pay? When are you going to pay? On what mode you are going to pay? All those things. Commercial substance. Commercial substance means whatever the kind of consideration that the entity gets, it should be so significant that it should be in a position to affect significantly the cash flow of the entity. If it does, we can say that there is a commercial substance. And finally, the most important condition upon which you will have problems is probability of collection. This is very, very, very important. I've marked over here, which means you will recognize the revenue. Of course, for that 4 more steps are there, but step 1 is important. You will recognize revenue only when there is probability of collection, which means you look at the customer, because revenue recognition will be doing from entity's point of view, right? In entity's books. So entity should look at the customer and see whether he has got the intent as well as ability to pay. Both conditions must be satisfied. If any of this condition is not satisfied, then this condition is not satisfied, which means there is no valid contract between the customer and entity, which means there is no question of revenue recognition. Based on this, questions are there, so keep this in mind. Are we done with this? Immediately, let's get on with an example and we'll cover all the 5 points. 5 conditions in step 1. 5 conditions in step 1. See here. A car subscription between Zoom Auto and customer for 12 months. You know what is Zoom, right? Right now it is not famous, but once upon a time it was. Customer pays 20,000 per month for the car that he takes on rent from the Zoom. Zoom Auto provides car. Zoom provides insurance as well for the car. Maintenance services also is provided by Zoom. Agreeable contract is there. They have signed the contract digitally. Customer must pay 3 months penalty if cancelling early, because this is for 12 months. And full KYC verification is done. Collection is also probable. So now we need to check in this example whether all the 5 conditions are satisfied. Condition number 1, approval and commitment between 2 parties. So is that condition satisfied? Yes, because there is a digital signature which these guys have signed, and payment mode is also confirmed. Got the point? So this much and all those things. So you have approval, right, and commitment. Second point, rights of each party has to be identified. Did they identify? Yes. Zoom Auto has got right to collect 20,000 per month, and customer has got right to use the car as well as insurance service from Zoom Auto as well as maintenance service from Zoom Auto. That is also clear. Okay. Third condition, payment terms identified. Yes. Auto debit will happen every month from the account of the customer for 20,000. Okay. Commercial substance is there. Yes. Entity is giving car to the customer, and customer is actually paying solid money of 20,000 per month, which will change the cash flow significantly of the company. You understand the point? So there is commercial substance. Probability of collection. Yes. Auto debit is there. Credit score is checked. So it is sure that customer will pay. Anyway, that condition is already given in the question. Collection is probable. So therefore, there is probability. Security deposit also usually they'll take. In case if some dent or something is happening, they'll cut that money and the balance will be paid. So all the 5 conditions has to be satisfied. So to put it very simple, if these 5 conditions are satisfied, step 1 is satisfied. That's all. Got it? Chalo. Approval and commitment, identifiable rights, identifiable payment terms, commercial substance, probability of collection, most important of the 5 conditions. Chalo. Few more examples I've given. You can just go through this. And one more point I forgot to tell you, that is you can check this website prasannakumar.com and free downloads column. From that you guys can download this particular material. Okay. Chalo. So I hope that doubt is also clear. I should have told it at the beginning. It's okay. Now, another special case is when step 1 fails but the money is received. What do you mean by this, sir? It's a special scenario. See, sometimes what happens is that step 1, there are 5 conditions. Any of those conditions will not be met. For example, even probability of condition will not be met. In that case, your step 1 fails, which means there is no valid contract between the customer and the entity. In that scenario, what will happen? Well, sometimes what happens is you cannot recognize revenue, but whatever the money that you received from the customer should be shown as deposit liability. Sir, what do you mean by that, sir? Let us look at the example. A customer pays 10,000 as booking advance for a service. Okay, sir. But later cancels it before the contract is finalized. So contract itself is not finalized, but cancellation has been done. So since the contract did not meet all the conditions, because there is no valid contract between the customer and the entity, step 1 is not satisfied. But you have received 10,000. Now, this 10,000, how should I treat? Should I treat it as a revenue or should I treat it as a liability? That depends upon whether you have an obligation to pay that money back to the customer. Now, if the amount is non-refundable, which means you don't have obligation to pay that money back to the customer, then you will treat it as a revenue. But if you have an obligation to pay that money back to the customer, then treat it as a liability. Simple. Because you have an obligation to pay it back to the customer means liability only. Na? Simple logic. It becomes revenue only when the entity keeps the money. When you will keep the money, when it is non-refundable, when it is refundable, you have to pay. In that case, it becomes a contract liability. Simple. So say for example, day 1, what will be the entry? Very simple. You have received 10,000. As of now, you are not sure because the contract is not yet cancelled and the non-refundable class is there or not, all those things. So bank account, you will debit to deposit liability advance. Say for example, for real estate flat, you have taken money. Okay. Later, customer says that no, I'm not interested to buy this particular flat. Whatever the token advance that you have taken, you can just keep it with you because usually that will be the condition. They'll not pay it back. Why? Because when I've taken token advance from you as a real estate guy, I'll not show the property to somebody else, na. So therefore, I'm losing an opportunity over there. So therefore, generally the deposit money will be kept with themselves. Once that confirmation is given by the customer that he is no more interested, then you convert this deposit liability into revenue. So therefore, deposit liability will be debited to revenue. Okay. The funny thing is, here you are doing revenue recognition without satisfying the further 4 steps, as well as in first step also 5 conditions are not yet satisfied. That is why we call this as a special case. So special case of deposit liability where without satisfying any conditions, because of the uniqueness of the scenario, you will be recognizing your revenue. However, to recognize the revenue, this condition should be happening. What is that? Non-refundable condition. And the customer must cancel the contract and non-refundable clause must be there. In that case, you can recognize. Got it? Otherwise, you'll pay the money back. That's all. Initially, you'll recognize a deposit liability. If it is refundable, debit deposit liability to bank. That's all. You'll pay the money back to the customer. As simple as it. Are we done with this? Moving on. Next one is contract term. So what is the only point that you need to remember in contract term? Generally, the term of the contract is whatever you write in the agreement. In agreement, if there are 12 months, you feel that 12 months is the contract term. That is where you are wrong. No. For example, a gymnasium enters into a contract with a new member to provide gym access for 12 months. Okay. At 4,500 per month. All right. Which means contract term accordingly has to be there for 12 months. Now, wrong. Because the member has right to cancel without penalty after 3 months. Which means till 3 months, he won't cancel. That's what you get from the contractual terms, right? So which means 3 months is the contract term because there is high probability that after 3 months he can cancel. If he cancels, then there is no contract for the next 9 months. Now, so how can you treat the contract term as 12 months when there is a probability of cancellation after 3 months? You get the point. So therefore, here the contract term is only 3 months because after that, neither party has enforceable right. The customer can cancel without penalty. So this is one new point that you need to learn. All right. Moving on to next one. What is the next one? We have combining contracts. Combining contracts. Now, sir, what do you mean by combining contracts, sir? Sometimes 2 or more contracts are signed together with the same customer around the same time and it must be treated as a single contract. So 2 or 3 separate contracts with the same customer pretty much around same point of time has to be treated as a single contract. How? Why? Very simple. First, we'll go with the exam and then we'll come back to the conditions. Okay. Chalo. Let's go with the example now. Now see here. Look at this, Nana. Infosys signs contract 1 ERP implementation for 80 lakhs. At the same time, it also signs employee training because for implementing ERP, that particular thing has to sign, and employee training also 20 lakhs. Signed on the same day, negotiated in a single meeting. Discount offered only because both the contracts were signed together. So you can easily find a link between both the contracts, correct? So therefore, even though there are 2 legal documents, commercial reality is that it is one single package. And as a result, combine the contracts, which means both these will be treated as one single contract for 1 CR, negotiated as a single package. One more example you will see. A builder signs with a customer, flat sale 70 lakhs, car parking also he sells for 5 lakhs, but they are entering into 2 separate contracts. But the point is, both of them are negotiated together with the same customer around same point of time. If the flat is cancelled, what will happen? Automatically car parking also will be cancelled, right? What he will do without the flat, the car parking in a residential building? Doesn't make any sense. So parking price also depends upon the flat purchase, right? Analysis, car parking consideration depends upon the flat contract. So as per Ind AS 115, both contracts must be combined into a single contract of how much? 70 plus 5, 75 lakhs. Consideration depends on the other contract. That is the condition, which means Now you have seen two examples. Now let's come here. If any one of the following conditions exist, then you will be combining the individual contracts entered with the same customer at a single point of time, or at pretty much the same point of time. What is that? They are negotiated as a single package. ERP example. The consideration is one contract depends upon the price or performance of the other contract. Flat example, where depending upon how much you negotiate the flat price, parking price will be there, which is nothing but we call it as amenities, right? Here if you are negotiating a lot, here the price they will not negotiate, right? One price is dependent on the other, or sometimes if you are negotiating the flat price, he will say, sir, we'll reduce the price in amenities. So one is dependent on the other. Third condition, the goods or services promised in the contracts are a single performance obligation. If any of these three conditions are satisfied, then you will be combining the contracts. Clear? Right, just try to remember that ERP package where you have negotiated that as a single package, two separate contracts, and try to remember the builder and parking lot, that is flat sale as well as parking place sale, right? One is dependent on the other. And one more point you need to see, goods or services promised in the contracts or a single performance obligation. Clear? You can see one more example over here. A company sells machinery and also provides training on how to operate it. If both are negotiated together and training is essential for using the machine, they should be treated as a single contract. Simple. So either both are negotiated together or one is dependent on the other. Or goods or services provided in the contracts or single PO. Got it? Then you will combine the contracts. Now coming on to the most important part of step 1. What is that? Contract modification. Now, what is this contract modification? This is where you guys need to understand. If you look at the wording in your Ind AS 115, it is called a change. Modification is obviously change in the terms of the contract. What terms? Price can change. That is very easy, sir. Price changes means I can easily understand. Scope also can change, or both can change. Sir, price change means I know. What do you mean by scope change? Scope change means additional goods are added with the existing contract, or additional services are added. Then the scope changes. Price changes means you can easily understand. Price will increase or price will decrease. That's all. If any of these two changes, either additional goods are added or additional services are added, or price has been increased or decreased, in either way, contract modification is happening. So, for a modification to exist, there is a change in scope, price, or both. And it is approved by both the parties, obviously. And it is legally enforceable. Now, the next question that you need to identify is, modification is happening now. Once the modification has happened, hereafter should I treat this as a separate contract or should I modify the existing contract as well? That's the major doubt that you'll have, correct? That is what we are going to do. Now, for that, we have divided things into two scenarios. Sir, what are two scenarios? Modifications that will be treated as a separate contract and modifications that will not be treated as a separate contract. Under this, again, there are two scenarios. So basically, there are three scenarios, okay? But you remember this way. Modification that constitutes a separate contract as one scenario. Modification that does not constitute separate contract as another scenario. For this also, we have an example. For this also, we have an example. For this also, we have an example. Got it? We'll see one by one. So let's start with the first one. Here. Look at this scenario, Nana. PK Limited is a service provider, okay? And he's providing office repairing and painting services for 50 days at 1800 per day. SK Limited is the customer. Fine. Total transaction amount will be how much? 1800 per day into 50 days, 90,000. Done. After 30 days, which means 50 days did not happen completely. In the middle, one more contract is entered between the same two parties, but this is a totally different service. Factory repair and painting. Office repair and painting is separate. Factory repair and painting is separate. And for that, the arrangement is 70 days it will take to repair the factory. Probably it is bigger than office. And same price, 1800 per day. So what is that you need to analyze over here? There is no discount on standalone selling price. Standalone selling price is 1800 per day. The price is the same. Whereas the service that you are providing right now is a separate service, distinct service, new service. Therefore, treat it as a separate contract. If you can see here, a modification will be treated as a separate contract if both the conditions are satisfied. That we have already discussed. One is it has to be a distinct service. The other one is the price has to be SSP. Simple. Services that are distinct and the price has to be SSP. Then treat it as a separate contract. Based on this example, easy to understand. Now, moving on to next one. Modification that does not constitute a separate contract. What kind of scenarios? Under this, again, there are two scenarios. Let's try to understand. Look at this example. It is an extension of the earlier example that we have done. PK Limited, same. SK Limited, same. Office repair and painting, same. 50 days at 1800 per day, same. Total transaction price, same. Okay. After 30 days, same contract, Factory repair and painting 70 days. This is where the change happens. Not 1800 per day, but 1500 per day. The service is new service, distinct. Yes, one condition is satisfied, but two conditions must be satisfied na, to treat it as separate contract. And both the conditions must be satisfied. So distinct service condition is satisfied, but second condition is not satisfied. It is not SSP, it is at a discount, because already you have done one contract. Now the new contract is at a discount. So at a discount, right? Sorry for that, discount. Okay. So can I treat it as separate contract over here? No. You got the point? One thing is quite clear, that you cannot treat it as separate contract because there is a discount. So I should write here no SSP. All right. Now, what should be the accounting that you should do? The word that you need to remember is prospective accounting. Sir, what do you mean by prospective accounting, sir? Anyway, one thing is clear. We are not going to treat it as a separate contract. Okay, then what, sir? Very simple. First of all, see what you have done so far. How many days are passed? 30 days, sir. Okay. 30 days, how much you would have recognized? 1800 per day, sir. So, how much you would have already recognized? 54,000, sir. All right. What is pending with respect to old contract? Sir, in 50 days, 30 days is done, sir. 20 days is pending, sir. For that 20 days, how much is the commitment? 1800, sir. So 20 days into 1800, 36,000. Fine, sir. What about the new contract? Sir, 17 days into 1500 per day, sir. Add that. Sir, total revenue is 1,41,000, sir. If you add these two, which means whatever is pending in the old contract plus the new contract, total revenue is 1,41,000. And total number of days is 90,000. Okay, divide both of them. Okay, sir, divided. On an average, how much it comes? 1566 per day, sir. From today onwards, recognize 1566 per day. From today onwards, do not touch whatever that has happened. Already 30 days you have recognized 1800 per day, 54,000 you have done, na? That you do not touch. Today onwards, this will be your revised number. This much you recognize. This is what we call prospective accounting. Retrospective means we'll touch yesterday as well. Prospective means we'll forget about whatever that has happened and we'll think from today about tomorrow. That's all. Clear? Right. If you look at the concept over here, new goods or services are distinct. Yes, sir. Factory repair and painting is distinct. But price does not reflect SSP. Yes, sir. 1500 is not reflecting SSP, which is 1800. Terminate the old contract and create a new one. The remaining revenue is adjusted prospectively on future basis. So old contract is gone. Now whatever that is remaining with the old contract plus new contract has been combined together, and then 1,41,000 divided by 90 days, you have got 1566 per day. Today onwards, you will be recognizing this much, 1566 per day in this example. Got it? Okay. What about the other case? The other case is, look at this example. Same example, same office repair and painting, 40 days at 1500 per day. Okay. Total transaction price will be 60,000. All right. After 25 days, the customer is asking for additional 10 days for existing contract at 1200 per day. So because of the customer, additional 10 days of work is happening for the existing contract itself, which is at 1200 per day. So there is no new service. It is not factory repair or painting. It is the same office only and same work. And as a result, because there is no new service, okay, there is no question of treating it as a separate contract. It will be treated as existing contract as well. But how will you do the treatment? Because there is no distinct service as well, you will do retrospective accounting. Sir, what do you mean by retrospective accounting? Very simple. If PK Limited, that is the service provider, knew that customer would ask for this delay for another 10 days, which means totally now it is becoming 50 days. But right at the beginning, they know that it is only 40 days. Now, because of the customer's modification, from customer's point of view, of course, PK Limited has agreed for the same. But now they know that in the middle of the contract, after 25 days, that the contract will take 50, not 40. But at the beginning, they thought that it is 40. Now, just imagine that at the beginning itself, if they know that it will be 50 days instead of 40. Then what would have been the revenue recognition? Imagination. So if PK Limited knew about this delay on day one itself, then the revenue recognition will be what? Very simple. So it will be 1500 for 40 days and 1200 for 10 days. Total revenue will be 72,000 for 50 days. On an average, you would have recognized 1440 per day from day one, which means for first 25 days, you would have recognized 1440 into 25, which means 36,000. But right now, how much did you recognize? 1500 per day, which means 1500 in 25 days, how much you have already recognized? 37,500. How much you should have recognized had you know about this delay from the day one itself? 36,000. Therefore, how much excess you have recognized? 1500. That much you reduce now. Revenue to be reversed on modification date, which means you are going back and disturbing it from day one. This is what we call retrospective change. retrospective application, or the technical word that your Ind AS 115 standard uses is cumulative catch-up basis. So from 26th day, you will continue with 1440 because you are rectifying from day one. Na? This we call it as cumulative catch-up basis or retrospective. Chalo, see here. Remaining goods or services are not distinct. It is same. So there is no new service and therefore treat it as a part of existing contract, but you have to adjust revenue on cumulative catch-up basis, which means from day one you have to revise everything, which we call it as retrospective change. Now some of the students might get doubt, sir, what do you mean by why would customer will ask for additional 10 days? Because customer asks for some change, some modification, some customization. In the middle he will ask, sir, why would this guy accept, sir? Because those are all part and parcel of the game, Nana. If I give you a real life example, you'll understand. Because it's a revision session, I don't have time to explain all these things in detail. But anyways, I'll give you an example. Otherwise, you'll buy heart. See here. L&T is building customization, Nana. Building hotel. They're trying to build the hotel. Customer is the one who is paying LLT. L&T, Larsen & Toubro, is building hotel building for the customer. Initially, they agreed at a particular design and all that. The work is going on. L&T is doing the construction. Suddenly, midway, customer will ask, okay, change the external design. I don't like this design. Do it like this. Change influences the whole construction work, obviously. But design change is not sold separately in the market. You can't do that. Highly integrated work, because design and the construction work are merged together, obviously. Based on design only, you will do construction. So therefore, new work cannot be separated from the old work. It is single PO. Modification affects the same PO. It will take extra time, extra days because of the design change asked by the customer in the middle. Therefore, adjust revenue cumulatively on catch-up basis, because there is no new service over here. Got it? You're doing the same building. And why would customer ask for additional days means, for that I'm giving you a reason. This is what happens in reality. Clear? I hope this example is clear. Chalo. Are we done with this? So with this, we are done with step 1. Let's continue with step 2, guys. Now this is a relatively small step and easier step, Nana. The real challenge will be for us when we go to step 3. Step 3 will take a lot of time. Again, step 4 and step 5 are easier. Chalo. Identifying performance obligation. In other words, simply put, we have to identify how many promises are made. Okay. A performance obligation is a promise in a contract. Step 1 is nothing but contract, na? To transfer. To transfer what? A distinct good or service. Distinct is the keyword over here. Or a series of goods or services that are substantially the same, have the same pattern of transfer to the customer. Sir, what do you mean by that, sir? Subscription service. Now you take Netflix subscription. It is a series of services. Month 1 service, month 2, month 3, 4, 5, 6, 7, 8. A series of services which are actually the same. And the transfer of service is also the same. The pattern is also the same. In that case, you will not call month 1 Netflix subscription as separate PO, month 2 as separate PO, month 3 as separate PO. No. All the 12 months put together, we call it as one single PO. Because pretty much you are repeating the same stuff. Housekeeping services as well. So anything where a service is being provided in the same way every single month over a period of time, then that entire period will be called as one single PO. Will be referred as one single PO. Got it? Chalo. In simple words, performance obligations are the deliverables under a contract. For example, in a contract to sell and install an air conditioner, how many POs are there? Very simple, sir. First you deliver the air conditioner, one PO. And after that you have to install that air conditioner, another PO. Simple. Two distinct services. Now one is a good, the other one is a service. So one is a distinct good, which is air conditioner. The other one is distinct service, which is installing that, right? So two promises. Got it? Another important thing is each may be a separate performance obligation if they can be sold separately as well. Will you be able to sell air conditioner without installation service? Yes, you can buy it from Amazon and you can get installation done from Urban Company, isn't it? Or you understand the point? You have already bought air conditioner from somewhere else and then you can buy installation service separately from Urban Company, which means both of them can be sold separately. Now that's the point over here. Or they can be sold put together as well. But if there is a possibility of selling it separately, then you can treat it as separate PO. That's what we are trying to say over here. Clear? So in other words, Nana, PO means either it has to be a distinct, the keyword distinct, good or service. Okay? Or a series of substantially similar kind of services. Clear? That's all. Okay, sir. Now, sir, what do you mean distinct good or service? Now, this is very important. This is the most important part of the step. So focus carefully. This is where many students get confused. Now, for a good or service to be distinct, it has to satisfy two tests. Okay. What is the first test? Can the customer benefit from that particular good or service on his own? Sir, what do you mean by on his own? You deliver a good to the customer. If he is able to use that particular good and get the benefit from that particular good, then it means he is enjoying it on its own. Or that particular good with readily available services, whatever the things that customer has got, is he able to enjoy? If these conditions are satisfied, it means customer can benefit from the good or service. Sir, what do you mean by this, sir? Right now, you will not get clarity, Nana. We'll see examples. Right now, just listen what the concept is. Then you'll be able to sync it with the example. Okay. So first thing is, can the customer benefit from the good or service on his own, or together with other readily available resources which is already there with the customer, or he can buy it from outside? Sir, what do you mean by this, sir? Wait. This is first condition. Second condition is the good or service separately identifiable? Means it should be capable of being distinct if it is distinct within the context of the contract. Sir, what do you mean by that? There is no meaning for that. The meaning is only negative. Sir, what do you mean by negative meaning? It is distinct if it is not integrated with other goods or services, it is not highly interdependent, it is not significantly modifying or customizing some other good or service. So this is an easiest way to understand, but the actual wording in your Ind AS 115 is this one. It is not distinct if it is integrated, highly interdependent, significantly modifies. So the point that you guys need to understand is that the definition is negative for the good or service to be distinct. So negative definitions, generally it is very difficult to understand. Therefore, I converted that into a positive definition. So what is that? The good or service is distinct if it should not be integrated with other goods or services, it is not interdependent, it is not significantly modifying or customizing the others. Sir, we are not able to understand this. Yeah, I know that. Let's get to the example. Now see here. Look at this example. I hope you guys are pretty much aware of Apple, MacBook, Apple Care, data migration. Of course, in India, we are not aware of data migration services. For example purpose, just try to understand. Okay. Customer is buying MacBook Pro. Okay, sir. We know what it is. Apple Care plus extended service. All right, sir. Data migration service where Apple shifts your data from old laptop to a new one. These three. Okay. Now, first question, what are we trying to do? We are trying to understand what are the distinct good or service in this particular transaction, in this particular contract. What is the first condition? Can the customer benefit independently, which means on his own, or that product with the customer is buying with readily available resources? For example, you buy Apple iPhone, Nana. There is no charger with that. So, can the customer enjoy that iPhone? Yes, he can enjoy, provided he can use this particular product with readily available resources with the customer, which is the charger as well as AirPods. You understand the point? Suppose if charger is not there, can you use this iPhone? No, it will go out of battery. Then what you will do? So in that case, it is not a distinct good or service. You understand the point? It satisfies the definition provided. Suppose it comes with lifetime battery, Nana. You need not charge. There is a technology, something like that. In that case, you buy an iPhone. Can you enjoy on its own? Yes. Then the first condition is satisfied. Then it is a distinct good. Or if first condition is not satisfied, let's take the current iPhone. Obviously the battery will get drained, so which means after 1 or 2 days you can't enjoy the product, correct? Therefore first condition is not satisfied. So can you enjoy the good on its own or in combination with something else that is readily available at your home, at your place, or at the place of the customer? Yes, I have a charger. You attach with that, you are able to use it. Charger is with you, you did not buy the charger. So having a charger with you in combination with the charger, if you're able to use the iPhone, that makes iPhone a distinct good. You understand the point? So look at the definition over here. Can the customer benefit from the good or service? A good or service is capable of being distinct if the customer can benefit from it on its own. Suppose infinite time battery for Apple iPhone. That's what I'm saying. That is the answer example for first condition. Or, it is not and or. If this is not possible, like in our case, if the battery is getting drained out after 1 or 2 days, together with other readily available resources with the customer. Customer already has got battery. Now, if you say, sir, no, sir, customer does not have battery, then can I say it is not a distinct good? No. Can he buy that from outside separately battery? Yes, sir, he can order from Amazon. That is also covered. Something that the customer already has or can easily get from other suppliers. Okay, sir, imaginary situation, sir. Customer is buying Apple iPhone with limited battery. Obviously, the battery will drain out after 1 day. and he does not have a charger. Apple also does not provide, and it is a very unique charger. Let's imagine, and it is not available to buy separately from outside as well. In that case, this is not a distinct good or service because you can't use it. You understand the point? Right. Now, other condition we have already seen. It is distinct if not, three conditions are there. We'll see that. Now, let's come back to the example. So, MacBook Pro, Apple Care plus extended service, data migration service. Now, see here. Can customer benefit independently? This is the first question on its own. Yes, MacBook gives benefit by itself. You can use it. Of course, it also comes with the charger. So, that point is not there. Apple Care is optional. Customer can buy it later. Of course, it can be sold separately as well. Data migration is optional. Many third-party vendors do it. So you can buy it from outside guys as well, which means step 1 is satisfied for all three. You can enjoy it on your own, and you can also buy it from outside. You understand the point? So therefore, the first condition is satisfied. If first condition is satisfied, that does not mean that the good or service is distinct. Second condition also need to be satisfied. What is second condition? Are they not integrated, not interdependent? Tell me one thing. Selling MacBook is not dependent on selling Apple Care. Why? Because you can just buy MacBook and you can go. Most of the people do that only. They don't buy Apple Care along with that. So therefore, one is not dependent on the other. Okay. So which means it is not dependent. That condition is satisfied. Apple Care does not modify MacBook. Is there one good or service significantly modifying the other? No. So that condition is also satisfied. Data migration does not affect performance of the MacBook. It is just an add-on service. So one is not interdependent on the other. One is not significantly modifying the other. One is not integrated with the other. So which means all these three conditions are satisfied. It is not integrated. It is not highly interdependent. It is not significantly modifying. And as a result, first condition is satisfied. Second condition is also satisfied, which is a negative condition. Thereby the result, there are three POs: MacBook, Apple Care, data migration service. Got it? I hope this is clear. Let's move on. Okay. I gave some examples as well here. You can just go through it. Already I've covered an example. Chalo. Now, this already I've explained. It is possible that there are multiple goods or services. Still, it may be considered as a single PO since these are interrelated or dependent on each other. For example, look at this. Laptop plus charger plus carry bag. You cannot carry a laptop which is heavy on its own. So it is dependent on charger. Are you able to understand? It is also dependent on carry bag. So therefore, there is an intention to sell all these two together. So all these three put together, we'll call it as one PO. We'll not call laptop as one PO. We'll not call charger as one PO. We'll not call carry bag as one PO. No, because they are interdependent, which means not interdependent is not getting satisfied because they are interdependent. When it is not satisfied, this is not satisfied. When this is not satisfied, 1 plus 2 is not satisfied. When they are not satisfied, you cannot call them as distinct service or distinct good. When you can't call them as distinct good or service, multiple POs are not possible. All these three put together, we call it a single PO. Got it? Now, finally, the understanding is, are there multiple promises of goods or services which are distinct? Yes, sir. Then each and every distinct good or service will be referred as one single PO. That's what you need to learn. Sir, no, sir. Multiple promises or multiple goods or service which are distinct or not there, then all of them put together will be considered as one single PO. Clear? I'll give you one more example. See here. Suppose you are taking CA final coaching. What you will do usually? FR, you'll buy it from somewhere else. AFM, you'll buy it from somewhere else. Audit, you'll buy it from somewhere else, right? There is no rule that you have to buy all the three put together for group 1. Correct? Which means this is a single PO, this is a single PO, this is a single PO. One is not dependent on the other. Correct? However, when it comes to CA foundation, that's not the case. Usually, people buy all subjects in one single go. In fact, single subjects are not at all offered. When they are not at all offered, you have to buy it as a group. Then can I say all the 4 subjects, say for example in CA foundation, accounts as one single PO, law as one single PO, maths as one single PO. Can I say like that? Economics as one single PO? No, because all those 4 being put together, it is sold. There is no option of getting them independently. You understand the point? In that case, everything put together, it's a single PO. For example, one more example I give you. Once upon a time, when I was studying in Chennai, there used to be a costing class that we need to go and attend in a particular institution. There, if you want to buy costing class, you cannot buy costing independently. It has to be taken along with one more subject. Which other subject you can choose, but 2 subjects must be taken put together if you want costing. If you want tax, you can buy tax alone. If you want audit, you can buy audit alone. You understand the point? But costing, if you want, it has to be in a combination. Now tell me, in that case, can I call costing as something a separate PO. No, here a combination only you have to take and call it as a single PO. You got the point? Yes. Chalo. I hope this is clear. Chalo, look at the series of goods and services, that is Netflix subscription. We have already seen that. Sometimes instead of one product, an entity provides a series of similar goods or services. Netflix is a service repeatedly over a period of time, that is 12 months, all of which follow the same pattern of delivery and transfer of control. Ind AS 115 says that entire series for 12 months, say for example in our case of Netflix subscription, will be treated as one single PO. This avoids unnecessary splitting of identical deliverables and simplifies the accounting, obviously. Lots of examples are there. Subscriptions, housekeeping, cleaning services, electricity supply, newspaper services, and all those things. Okay, in all these cases, each day's or month service is similar and transferred in the same pattern. Therefore, all put together for the entire year, we call it as one single PO. Every day, you will not call it as a separate PO. It doesn't make any sense. Got the point? Yes. Chalo, with this, we are done with step 2. So, the summary of step 2 is very simple. Identify whether it is a distinct good or service. How to identify? Check whether customer can benefit with the product, if it is a good or service on its own, or that product or service, that good or service in combination with something that is available with the customer, or customer can buy it from outside and then with combination he can use it. This is the first condition. Plus, that particular good or service are not interdependent. They are not dependent on something else. They are not integrated with something else, which something else means some other good or services. They are not significantly modifying something else as well. In that case, both the conditions are satisfied. Then finally, you can call that particular good or service as a distinct good or service. Now, what is the use of identifying a distinct good or service? Once it satisfies these two conditions and you can call it as a distinct good or service, that transforms into one single PO. Got it? If it does not satisfy the distinct good or service, then all the goods or services put together will be called as a one single PO. Otherwise, each and every good or service, if the conditions, both the conditions are satisfied, will be called as a single PO. In that case, you will have multiple POs. You will have multiple POs. What is the importance of multiple POs? Because next step is transaction price, and each transaction price will be correlated with a single PO. Thereby, if one PO is satisfied, immediately to that extent, whatever the transaction price that you have allocated, that much revenue will be recognized. That is why this is important. Are you able to get me? Chalo. I hope we are done with step 2 as well. Now come to step 3, Nana, determining the transaction price. Let's continue with step 3, determining the transaction price. Now, Nana, this is the most important step and lengthiest of all the steps, all the 5 steps, as well as this is the toughest. Okay. So therefore, we will spend good amount of time on this particular step because there are a lot of points and concepts to be covered. Step 4 and step 5 will not take much of your time once we are done with this. This is the important. In fact, out of all the 5 steps, this is the most important. The least important is step 1 that I've told you, except for that one point. In step 1, there are 5 conditions now for determining a proper contract between the customer and the entity. The last condition is very important, where the payment should be highly probable. That you should have high probability of receiving the payment from the customer, which means customer must have the intention as well as the ability to pay. Keep this in mind. There are so many questions based on that particular concept. That's why I was stressing. Other than that, all other points are not at all important in step 1. Okay. Whereas when it comes to step 3, there are a lot of points which are repeatedly asked in multiple questions, like 10 questions, 15 questions, same concept. Okay. So when I'm going with the revision sessions, I'll highlight those points and then I'll go such that it will be totally exam focused and exam oriented for you, right? Chalo. Once performance obligations are identified in step 2, which we have already done, the next task is to find out how much revenue or consideration or transaction price the entity expects to receive for fulfilling those obligations. What obligations? Performance obligations in step 2. Okay. So here you can say in general terms, revenue is nothing but transaction price is nothing but consideration. Although little bit of technical differences are there, but in general parlance, we'll use them, like similar things like inventory, stock. Although inventory and stock are not exactly the same words with same meaning, there is a subtle difference, but still we use it in common parlance. Chalta hai. So same way, transaction price, revenue or consideration is nothing but the same. So we as an entity, we do some performance obligations, okay, deliver some service or deliver some goods to the customer. In return, customer what pays us? I mean, customer pays us how much? That is nothing but you can call it as consideration or transaction price or revenue. Anyways, the transaction price is the amount of consideration, that is payment, that the entity expects to be entitled to receive in exchange for transferring the control of promised goods or services to the customer. Why has used the word expects? because there are two types of consideration. One is fixed, the other one is variable. Variable is always there is a question mark. So you expect this much to be received. Fixed consideration, there will be no doubt. That's why I've written here pakka. You'll get it for sure. There is no uncertainty. But when it comes to variable consideration, it is there. That's why we have used this particular word. Okay. One important point is very simple. If entity collects any amount on behalf of third parties, it does not belong to the entity. For example, even when we try to, sell our courses, right? If you buy FR, obviously it will be inclusive of GST, right? So that GST directly goes to the government, obviously. So can I say that that's the revenue for me? That's obvious. It's not. So anything that you collect on behalf of the third parties like GST, sales tax and excise duty must be removed. Very simple. If your invoice is 1,18,000, your actual revenue or transaction price is 1 lakh. Got it? So let's call this as transaction price or consideration. Okay, we'll call it as revenue after step 5. Okay, for our own comfort. So right now let's call it as transaction price or consideration. So how many types of transaction price or consideration are there? Very simple, two types: fixed, variable. What is fixed? It is a fixed amount that is mentioned in the contract between the customer and the entity in step 1, and that too customer will pay it without any condition. So you as an entity receiving that is pakka, right? It always included in the transaction price because there is no uncertainty. Got it? For example, a consulting firm agrees to provide services for 10 lakh fixed fee. Transaction price is 10 lakh because you will get it for sure. Sir, then what do you mean by variable consideration, sir? There is always a question mark. Sir, what do you mean by that, sir? Because variable consideration depends upon future events or performance outcomes. Sir, what do you mean by that, sir? For example, performance bonus is a variable consideration. So if you perform, you'll get it. If you don't perform, you'll not get it. You understand the point? For example, I gave you a construction contract, Nana. You said that you'll be taking 2 years time to complete it. I said, if you can finish it off in 1.5 years, that is 1 year, 6 months, then I'll give you 20% bonus. Now, whatever that I've promised normally, let's say I promise that I'll be paying you 10 lakhs, no matter what, once you do the construction, irrespective of the time that you take to complete it, okay, that 10 lakhs is nothing but fixed consideration. But when it comes to this 20% bonus, I gave you a condition, a future condition. If you can finish it off within 1.5 years, then I'll give you 20%. Otherwise, I'll not give you. So therefore, variable consideration always depends upon future events or performance outcomes. In this case, if you're able to finish it off within 1.5 years, then I'll give you that 20%. That 20% accounts under variable consideration. Clear? Penalties also. Suppose your normal timeline is 2 years. Same example we'll take. If it goes beyond 2 years, if you delay the project, then I'll penalize you. In that case, your consideration gets reduced. That's what I've written here. Reduction in fee. Discounts, rebates, refunds, everything is dependent on sales volume. All these put together, we call it as variable consideration. Now, what is the treatment when it comes to variable consideration? Sir, fixed consideration though very easy. Always you'll be including that in the transaction price without any question mark. Whereas when it comes to variable consideration, will you be doing the same thing? The answer is no. The entity must estimate how much variable consideration it expects to receive. So you do the estimation, based on that you recognize the variable consideration. Recognizing means that will be added to the transaction price. That will be added to the transaction price. So when you try to solve any question, the moment you see fixed consideration, obviously it will form part of transaction price. But when you see variable consideration, you need to think, you need to see how much the entity is estimating. Accordingly, some portion of it will be included in the transaction price. Clear? Okay. Look at the example. A consulting firm will receive 1 crore fixed plus 10 lakh bonus if it completes the work within 6 months. So 1 crore is fixed. That will be included in transaction price no matter what. 10 lakhs will be included if the company estimates that it will be able to finish off the work in 6 months. Otherwise, it will not be included. Got it? See here. If based on experience, the company expects a 60% chance of achieving this. Achieving what? Completing the work within 6 months. It estimates that variable consideration accordingly, which means it will be including that. Depend upon the method. Depends upon the method. Sir, what do you mean by that, sir? See, we have two methods for estimating variable consideration. What are those methods? Expected value method, most likely method. Sir, what do you mean by expected value method? What do you mean by most likely method? Very easy, Nana. You look at the possibilities in future. Sir, multiple possibilities are possible. Then you will choose expected value method. Sir, only two are possible. Either you will get it or you don't get it. In that case, you will be going for most likely method. Sir, can you explain it in detail? Yes, we'll go with an example. Look at this example. PK Limited enters into a contract with SK Limited for supply of a product in 6 months time. Okay, the fixed consideration is 6 lakhs. ये तो clear है. So 6 lakhs will obviously be included in what? The transaction price. 6 lakhs is by default included. Okay. Now look at the variable portion. A bonus is also payable for early delivery of the product. Okay. The amount of bonus and probability percentages are as follows. You've got how many possibilities here? See, 1, 2, 3, 4, 5. 5 possibilities means can I go for most likely method? No, here only 2 possibilities need to be there. Then automatically it will be expected value method. The expected value method is very easy. You just take each and every possibility, you multiply with the respective probability, you will be getting expected value. Which means your bonus will be 1 lakh if delivered within 3 months, 75,000 if delivered between 3 to 4, 60,000 4 to 5, 40,000 5 to 6, nil after 6 months. So simple, 1 lakh into 30% plus 75,000 into 25% plus 60,000 into 20% plus 40,000 into 15% plus 0 into 10%. That's what we have done here. And you got 66,750 expected value. Add that, fixed plus variable is your total transaction price. That's all, simple. Okay. Sir, what about this most likely amount? Sir, very simple. Look at this example. The amount of bonus is like this, same example only. Within 6 months, if you are able to complete, you will be getting 2 lakhs. Greater than 6 months, 0. That's all, only 2 options. It is not like this much, this much, this much. Here we have got multiple possibilities. Now here it's not like that, only 2. Either you will get 2 lakhs or you will get 0. So when there are only 2 possibilities, what you will do is that you will look at the most likely scenario. 75% probability that you will be getting what? 2 lakhs. 25% probability that you will not be getting anything. So which is most likely to happen? 75%. So therefore directly take 2 lakhs. Here you will not be multiplying with probability. You understand the point? Most likely means only 2 options. Either you get it or you don't get it. See the probability which one is most likely, which means generally it is greater than 50%. Then that full number will be taken. Here again will not be multiplying 2 lakhs with 75% and then take the resultant number. No, entire 2 lakhs will be taken because out of these two we are thinking which is possible. This is most likely, take that number. So 2 lakhs will be added. Transaction price will be 8 lakhs along with fixed consideration. Fixed consideration by default will be included in the transaction price. Got it? That's what we have got here. See here. Ind AS 115 allows 2 methods to estimate variable consideration because when it comes to variable consideration you must estimate. Expected value method, most likely method. Expected value method when there are multiple possible outcomes, which is nothing but weighted average. You multiply the value with the respective probability. Most likely method when there are only 2 possible outcomes. Take the most likely outcome, as simple as that. It can be 0, it can be full. Take that full amount. Right. Are we done with this? Chalo, moving on to the next concept. Now, Nana, look at this, Nana. This is very, very, very important. I've written here clearly. Limiting recognition of uncertain variable consideration. See, already we know that variable consideration is uncertain because it depends upon future events, right? And what does Ind AS 115 say? You need to estimate it. Now, how to estimate it? There are 2 options, expected value method as well as what? Most likely method. Depends upon how many possible outcomes. If you have multiple possible outcomes, you go for expected value method. Otherwise, you go for most likely method if the possible outcomes are only 2, either yes or no. Anyways, after that, see, look at the wordings here. That's why I've highlighted. Even after estimation, we have already estimated it. By applying either of these 2 methods, as the case may be, estimation of variable consideration is done, Nana. After that, you need to apply this condition. This is very important. Variable consideration should not be included in the transaction price only. Should be included in the transaction price only when it is highly probable that there will be no significant reversal of revenue later. Sir, I'm not able to understand this sentence. That's why I gave you alternative sentence. If there is low probability of significant reversal, then include the variable consideration in the transaction price. Already we were discussing about inclusion of variable consideration in the transaction price only. Na? For that only we have calculated this. We have seen the example over here. We multiplied using expected value method. For example, in this example, we got 66,750 and then we added 66,750. Now for adding this 66,750 after estimating, see, till here you have done estimation. Please try to follow what I'm saying. Otherwise, problem solving will be very difficult. Till here, what you have done is estimation because you have done the calculation. Now, the next step is to add it to the transaction price calculation, which you have added eventually. But to add this, you need to check for this condition. What condition? Is there any possibility of significant reversal in future? Which means, reversal means what? Obviously, the variable consideration which you are thinking that you will get it, you will not get it. Then what is the logic in including that in the transaction price? That is the logic, isn't it? That's why we are saying that if there is a significant reversal in future, for that if there is high probability, they do not include variable consideration, even after applying either of these 2 methods. You understand the point? If there is no probability of significant reversal, that's what I've written. Low probability or no probability of significant reversal, which means whatever that you add today, variable consideration, in our example, it is 66,000. If you add 66,000 today, tomorrow you need not reduce it, because there is no possibility of significant reversal. In that case, you can add today. But if you think that today you are adding 66,750 in our example, but tomorrow maybe there's a chance of reversal, thereby you might have to again revise the variable consideration from 66,750 what you have added today to 50,000 or 40,000, something like that. If there is a high probability of that reversal happening that you can see today, then why would you add 66,750? You understand what I'm trying to say? So this is a kind of a constraint. This condition is called constraint. Constraint means it is limiting your variable consideration recognition. It is limiting your variable consideration recognition. Got it? Okay, sir, enough, sir. You have said all the concept. First of all, in what scenarios this will happen? 3 cases are there. First, outside the entity's control. Sir, what do you mean by that, sir? I'll give you an example. For each scenario, I've got an example. So let's go with the example. Now, see here. That's why without examples, you'll not be able to understand anything in this particular Ind AS. Look at this example. ICICI Prudential AMC Asset Management Company is there. What is the contract? Portfolio management fee. If you look at the terms, the base fee is 1% of assets under management and bonus fee is 10% of the returns above Nifty 50. Now tell me, in this case, variable amount is nothing but bonus over here. Assets under management, wo to TK. To some extent, there is a certainty. But when it comes to bonus, it is 10% of the returns up and above Nifty 50. Suppose Nifty 50 is doing 10%. You should do more than this 10%. And in this additional, how much extra you're doing, in that 10% will be your bonus. Now, tell me one thing. Is this under the control of the company? No, outside the control of the company. Na? Stock market movement, foreign flows, macro outcomes. Since performance depends upon external factors outside the entity's control, there is a high probability of significant reversal. Therefore, don't recognize. It's a constraint on recognizing variable consideration or adding variable consideration to the transaction price. So therefore, the bonus cannot be included in TP initially means transaction price. Why? Because there is too much uncertainty. Probability of reversal is high. If probability of reversal is high, do not add variable consideration in the TP. So recognize revenue only when the outcome is no. Got the point? Okay, so this is about first scenario. What is the second scenario? The uncertainty will not be resolved for a long period of time. 4 years, 5 years. For example, here 5 years. Sir, what is that, sir? I'll give you another example for that condition. See here. Pharmaceuticals is there, Dr. Reddy's. And what is the contract? Licensed drug to Novartis. Okay. There's a company called Novartis. Okay. Terms. Fixed fee will be 100 crore. Okay. Bonus milestone is 50 crore when the drug gets US FDA approval. Okay. Fixed fee 100 will be included in TP, transaction price. There is no doubt in that. 50 crore should be included or not in the transaction price. That is the question. Look at the FDA. That can be included once this clarity comes. Now, when does a US FDA approval will happen? Usually, it will take 3 to 5 years. It also involves clinical trials, external influences, all those things, probably political stuff and everything. So, therefore, now tell me, can I include this variable consideration? No, because the time gap is too long. So, there's a high probability of significant reversal. Therefore, do not include. Got the point? That is the example for second point. Look at the third point now. Look at the last point, Anna. The entity has a history of changing terms, offering price concessions in future, which means today they'll commit something, tomorrow they'll reduce that value. So when you know that tomorrow you are going to reduce that, why should I add it in the transaction price? Simple logic. For example, look at this. Zoho has given something called software SaaS with a flexible pricing. Who is the customer? Government. Annual subscription, initially Zoho says that it's going to be 12 lakhs. But if you look at the history of Zoho, always they negotiate later and they'll give 20 to 30% discount due to budget constraints, usually. That's what they have been doing. So once you know that you are Zoho, so you need to understand that anyway you're going to give that 20 to 30% discount. So reduce this annual subscription by 20 to 30% discount, and that much only you recognize today. So even though the signed amount is 12 lakhs, because there will be concessions later and you have a history of doing that, do not include full amount in TP. So this entire 12 lakhs should not be recognized as TP. Reduce this much, okay, and the balance only recognized in TP as of today. So reduce variable consideration to a lower amount that is highly probable, which means mostly you'll reduce 30%. Are you able to understand? For each and every scenario, I gave you an example. So when you are solving a question, if there is a scenario where it is outside the control of the entity, okay, or there is a scenario where things will happen after bonus is being given, but it is linked to 4 years, 5 years, or there is a scenario where there's a history of the company, always they'll offer discounts or concessions in future, not now. So today they haven't taken any decision. You understand the point? In these kind of situations, you will be restricting the recognition of variable consideration in the transaction price. You will reduce it. But when you're writing the answer, you should exactly use these words only, Nana, because there are key sentences. You have to use them as it is while writing the answer. Then only you'll get marks while writing ICA exam. So what is that sentence? There is a constraint condition for variable consideration where recognize variable consideration to that extent in the transaction price, only to that extent where it is highly probable that significant reversal in future will not happen. If you are sure that significant reversal in future will not happen, for that there is high probability, then you include that variable consideration in the transaction price. Fixed consideration is always included in the transaction price. There is no discussion over there. You got the point? Our discussion is only about variable consideration. This is very important point. I'm repeating again. I've seen so many questions based on this particular point. So many questions, which means in so many questions, one of the adjustment is based on this point. So therefore, you remember this. Got it? Next concept. Reassessment of variable consideration. This is very simple concept, Nana, because variable consideration is always uncertain. Initially, you did one assessment. After the year end also, you have to do one more assessment, na? Because it will keep on shifting because the probability will change. At the end of each reporting period, entity must reassess the transaction terms based on latest estimates. Look at this, Nana. If the estimates changes, adjust the revenue on cumulative catch-up basis. This is also important. So whenever there is a reassessment of variable consideration, in step 1 for contract modification, we have seen in one scenario where there is no distinct service, where there is no new service, and all those kind of things. In that case, what we will do, we'll do the change retrospectively. We'll do cumulative catch-up basis. Here also, we have to do the same thing. When you do reassessment of variable consideration at the reporting date, that is on 31st March, you do the change retrospectively. Go back and change from day 1. Okay. So this is how it works. Revenue that should have been recognized till date from day 1 minus whatever that you have recognized till date, that will be adjusted in revenue, which means either you will increase it or reduce it, which means you will reverse the revenue as well, as the case may be. Depends upon the scenario. Got it? For example, 10 lakhs is what the revenue is recognized, but you should have recognized 7 lakh. Then today you will recognize additional 1 lakh. That's all. Suppose if it is 9 lakh, then you will reverse to the extent of 1 lakh and you will reduce the revenue. That's all. Simple. This is not that important, but just keep it in mind that you will reassess your variable component at the end of the reporting period. That's all. Not that important point, but just for your information. Sure. Now coming on to another important area of step 3, significant financing component. Now this is where I want you guys to focus. Focus absolutely. Now, what do you mean by significant financing component? Very simple, Anna. See, I as an entity, I provide you goods or services. You make payment. That is nothing but we call consideration. So, I provide you the goods today itself. You make the payment today itself. There is no problem. But I provide the good today. You pay after 1 year or 2 years or 3 years. That is the problem. Because whatever you pay after 3 years will not be just the transaction price. Now, in that interest element will be included, which we call it as financing component. That you can't call it as a revenue. So thereby you remove that. And that's where this concept comes into picture, significant financing component. Similarly, I provide services for a period of 3 years. But for 3 years, customer as you paid advance today itself. Full payment is done today itself. Which means in this case, you have paid me early. You understand the point? If you have paid me early, because you have paid 3 years early, definitely I would have given you steep discount, and that discount also includes financing component because you are financing me as a customer. See, when it comes to significant financing component, understand, Anna, either customer will pay early or customer will pay late. If customer pays late, okay, in that case, entity is providing finance to the customer, correct? If customer pays early, then indirectly customer is financing the entity. So when customer is financing the entity because customer paid early as an advance, then in that case for entity there will be interest expenditure. Whereas if entity is financing the customer, where customer is paying late after 2 years or after 3 years, then entity is financing the customer. Therefore for entity, it will charge interest from the customer and that becomes interest income for the entity, which should be removed from the revenue and shown separately. That is the whole intention. I hope you have got the entire concept over here. Ready? Okay. If there is a significant time back, that's why time gap, that's why I'm talking about like 2 years, 3 years and all that. If there is a significant time gap between when the customer pays and the entity delivers goods or services, if there's too much of a time gap, then that particular contract, whatever the transaction price you have got in that, it includes a financing element which you need to remove. In one case, you'll treat it as an interest expenditure. In another case, you'll treat it as an interest income. Got it? As the case may be, whether entity is financing the customer or customer is financing the entity by paying advance. Either the entity is providing finance to the customer, which means here customer is paying late. In that case, it will be interest income for the entity. Or receiving the financing from the customer, which means customer is financing the entity. In that case, entity will get advance. If entity is getting advance, it has to pay interest to the customer. So therefore, it will be interest expenditure. Simple. Therefore, the entity must adjust the transaction price for the time value of money. In essence, discount or accrue interest to reflect the real value. The reason is very simple. The goal is to recognize fair value of the goods or service provided by the entity to the customer. Simple. But when there is a significant time gap, the transaction price will not just reflect the fair value of goods or service, it will reflect something extra or something less in case customer pays advance. You understand the point? So therefore, we need to adjust it such that whatever the revenue that we recognize or the transaction price that we take into the books should exactly reflect the fair value of the goods or services. Logical, right? Say for example, if customer agrees to pay 1,10,000 1 year after the delivery of goods, which is actually worth 1 lakh, then 10,000 is what? Financing component. Simple. This already I told you. Okay. Chalo. Let's start with first example where customer pays late, which means entity is financing the customer. That's what I've written here, late. Ready? Look at this example, Anna, to understand. PK Limited sold a laptop to SK Limited. Fine. The cash price of the laptop is 80,000, which means I give you laptop. Say for example, imagine this is the laptop. Immediately you give me money. So in that case, it will go for 80,000. But because you're gonna make the payment after 1 year, I'm charging you 88,000. So naturally, 88,000 is not the transaction price. It cannot be recognized as revenue. So you need to eliminate the interest element. So how the entries go? See here. Journal entry on day 1 where you have already transferred the control. Why? Because it's a laptop, na. I gave it to the customer, so transfer of control is done. Why? Because customer is about to enjoy it now, right? So in that, what you will do? Very simple. You will debit debtors or trade receivable to revenue, which is 80,000 only. Why 80,000? Because that is the cash price, not the transaction price of 88,000. Because it is after 1 year, customer is going to pay late, which means entity is financing the customer. Definitely there is an interest income that the entity will get from the customer. Got it? So 80,000 is the cash price. To that extent only revenue should be recognized. Remaining 8,000 will go for interest. Got it? So then what you will do? You will increase the debtors to the extent of interest and recognize interest income. So now the debtors is showing a balance of 88,000 after these two entries. Once customer makes the payment, you will debit the bank account for 88,000 and cancel the debtors, which is trade receivable. That's all. Easy. Done and dusted. So in P&L account, what you will show? Revenue will be shown to the extent of 80,000 only. Other income, interest income, you will show it separately as 8,000. Clear? So revenue. Otherwise, if you don't put this rule of significant financing component, you'll be inflating your revenue. You'll be showing it as 88,000. That's not correct revenue. Then you are hyping the revenue, which is wrong. Got it? Yes? Okay. This is one scenario where entity gives financing because customer pays late. If customer pays early, then what will happen? Let us see that. Where is that example? Yeah. Customer pays early. Look at this example, Nana. This example is enough, Nana, for you to understand the entire concept. Remaining this, based on this example only, I've written content. Now see here. PK Limited sold a customized product to SK Limited. We'll see real life examples also, don't worry. The delivery date is after 1 year. Okay. The delivery date selling price product is 3,45,000, which means entity gives a product to the customer after 1 year. So today product is not given. After 1 year, when I'm delivering the product after 1 year, on that day the price is 3,45,000. But today customer has made the payment on day 1 itself, which is 3 lakhs. You understand the point? Which means who is financing whom? Customer is financing the entity. Which means who has to pay interest to whom? Entity has to pay interest to the customer. Which means it will be an interest expenditure. Now, customer did pay 3 lakhs on day 1. But the transfer of control of goods or services will happen after 1 year in future. On that day in future, the value of that particular product which is getting delivered is 3,45,000. Right? Okay. So on day 1, what happens? 3 lakhs worth of money you have received? Yes. So bank account debit. Simple. 2, can I recognize this as a revenue on day 1 itself? No, 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 no. To recognize revenue at the beginning of Ind AS 115, what did I say? Transfer of control should happen. Transfer of control, when it's going to happen? After 1 year, which means now can I recognize the revenue? No. So treat it as a liability, advance income or contract liability. Sir, in the previous example, when customer paid late, you have recognized revenue? Yes, because transfer of control did happen. Here, you sold the laptop now. So transfer of control did happen. Therefore, you can recognize revenue only to the extent of cash price. That's the point. So to recognize revenue, that's why I started with the basics itself. At the beginning of Ind AS 115, when we have started, this was the point that I was stressing upon. Transfer of control must happen to recognize the revenue. Are you able to understand? So here, did transfer of control did happen as on day 1? No, it's going to happen after 1 year. So there is no transfer of control. In that case, you will treat it as a contract liability or advance income. That's all. This is your first entry. But you received the money. Okay. Because customer has financed you, you have to pay interest income to the customer. Sorry. You have to pay interest to the customer, which will be an interest expenditure. Yes. So to that extent, increase the contract liability. Okay. Interest expenditure is a expenditure. Obviously, debit that 45,000 to contract liability 45,000. All right. Then journal entry on the delivery date will be delivery date. What will happen is you are transferring the control of the good to the customer. Now you can recognize revenue. On the delivery date, what is the price? 3,45,000. That's the fair price of the product, fair value of the product. So recognize revenue at fair value of the product, which is 3,45,000. Are you able to get me? And you will debit the contract liability. Why? Once you recognize the revenue, there is no more liability. Why did you create liability? In case in future, if you fail to deliver this product, are you able to understand? Then there is a risk now today itself. If I recognize the revenue and tomorrow you are not able to deliver this product, then I have to reverse the revenue. Why to do all those things? Okay, so there is a little bit of uncertainty, so I'll treat it as a contract liability. So in case tomorrow if you fail to deliver the product, then I have to return this money back. Therefore, I'm recognizing that as a contract liability. That is the logic. You understand the point, right? And then because customer has financed me, I have to pay interest. That's why this much of interest. The difference between this 3 lakhs and 3,45,000. To that extent, contract liability is increased. Now, total in case if I'm not able to deliver, I have to pay back 3,45,000 to the customer. You understand the point? But luckily I delivered. Therefore, today the rate is 3,45,000. To that extent, you recognize the revenue and there is no more liability. Na? So debit the liability and cancel it off. That's all. This clearly demonstrates a significant financing component where payment is received in advance and the interest expense is recognized over a period till delivery exactly as required by Ind AS 115. That's all. Once you are done with these two, the concept is done. Nana. That's it. Nothing else. You can see here. Case 1, payment by customer after the entity performs its obligations, which means payment by customer is late. This is nothing but late. Okay. The situation arises when the entity delivers goods or renders services first and the customer pays late, which means basically entity has given financing to the customer. Therefore, entity will charge what? Interest income. That's all. You will recognize the revenue at cash price because transfer of control did happen on day 1 itself. Because entity has performed its obligation. Na? Therefore, transfer of control did happen. Therefore, you can recognize the revenue. But do it at cash price. As in case of our example, 80,000 is there, na, that much. So, therefore, look at the entries. Trade receivable to sales revenue at cash price. In our example, what was that? In our example, 80,000. Got it? Then, you will be having interest income, right? So, interest income. And to that extent, increase the debtors, right? Because that guy has to pay you more. Finally, transfer the interest income to P&L account. That's obvious. Therefore, I did not write this entry in the example. Once customer makes the payment, debit the bank account and credit the debtors or trade receivables because there is no more debtors. Customer has made the payment. That's all. Simple. All right. Another point is how to calculate that cash selling price. In my example, I just gave you that cash selling price directly. If you can see here, where is this late example? Here it is. I gave you cash selling price directly here, 80,000. Now, what if it is not given directly? If that 80,000 is not given directly, what will happen? In that case, how will you find cash selling price? In case where the customer is paying the money to the entity in installments, in that case, what you will do? Very simple, find out the present value of future cash inflows using appropriate discount rate. Based on that, you will be able to find your cash selling price. Now, remember, cash selling price means we are talking about selling price here. So, always it includes profit. So, therefore, cost of goods or services plus profit margin will be called as selling price. Are you able to understand? So, normally cash selling price will be given in the question. In case if it is not given, if it is given as installments, which the customer is paying in future over a period of 4 years or 5 years, just discount that. Okay. Find out the present value at an appropriate discount rate. And that present value is nothing but your cash selling price. As simple as that. But ensure that when you are talking about selling price, it should be including cost plus profit margin. Because in some questions, this point also will be tested. That's why I'm telling this. Clear? Discounting rate, what you will use? Very simple. Market interest rate will be used. In case if market interest rate is not given, then any rate that is given in the question, that will be used. Simple. Which means I've written here in brackets, the rate should not be tainted. It should not be an artificially inflated or deflated rate. It should be reflecting the market rate. See, we have already done so many chapters now. For example, you are giving loan to employees at 6% interest. Normally, the similar loan will be given at 10%. 6% is tainted rate now. That's what I'm trying to say. The rate should not be tainted. What you're talking here, the discount rate now to discount the future cash flows, it should not be tainted. It should not be inflated or deflated. discount rate. It should be correct discount rate, which shall be reflecting the market interest rate. Clear? That's the only point you need to remember. So when it comes to cash selling price, if it is directly given, then that's fine. If it is not given, then you take all the future cash flows, discount it at the discount rate, which should be the market rate, which should not be tainted, and then you should be getting your normal cash selling price. That's all. This normal cash selling price is the price at which you will recognize revenue on day one. Later, you will add interest, you will increase the debtors or receivables, and finally, once they make the payment, bank account debit to receivables or debtors. That's all. There ends the matter. Done? Chalo. In case 2, what happens? Customer pays you early in advance, which means customer is financing the company. In this case, the customer pays first, which means entity delivers goods or services later, meaning the customer is effectively financing the entity. This also we have seen. Entries also we have seen already. Contract liability. Okay. Based on this example, that's all. Both are covered. This is a revision session, Nana. Once we cover the example, literally we have covered the concept. So I should not be spending too much of your time because we don't have time being a revision session. Okay. Right. So with this, we have completed significant financing component. Now, what if in certain special cases, financing component is not significant, which means it seems like there is a financing component and you'll be tempted to treat it as a financing component, but actually there is no financing component. So these are all 4 different cases of financing component traps. You got the point? For each and every scenario, we'll see an example so that you'll understand concept better. Okay, shall we? Let's continue, guys. So there are certain scenarios where it feels like a trap, where you feel that financing element is involved, but actually it is not. So there are 4 special scenarios where you should not be considering financing component. All right. Now, what are they? Customer pays in advance, but the timing of transfer is at their discretion. Whose discretion? Customer's discretion. So customer pays money first, buys a recharge card, and then we never knows when he will recharge. Earlier it used to be the case, now it is not there. Earlier we used to buy a small recharge card and then there used to be a code, we used to scratch that and then we used to recharge for the prepaid mobile phones. You got the point? But that is in the hands of the customer, na? You understand the point? So here nobody is really controlling the others, nobody is really financing the other party. So in this kind of scenario, do not consider that timing difference as what? Significant financing component. For example, you can see the example over here. Airtel sells 500 prepaid recharge on 1st January. Customer uses this balance maybe in Jan, maybe later, or maybe even in March. So customer decides. So it is at his discretion, at his choice. Okay. So even though Airtel has cash before service, but this is not financing. If customer wants, the moment he buys the recharge card, at that time itself he can scratch and he can use the service. He has chosen not to use it now and use it at a later point of time. That is at his discretion. So that you cannot call it as a significant financing component. Got the point? So because customer controls, this is one scenario. Another scenario is a kind of royalty based scenario, means substantial part of consideration depends upon future events. Because for royalty, the sales needs to happen. After that, only a percentage of that will come to you as a revenue, isn't it? So the nature of the transaction itself is that you have to wait for the sales to happen eventually. So if you look at this example, sales based royalty, Tata Steel licenses its technology to JSW. Okay. Payment terms is 2% of the sales. Now the payment from JSW to Tata Steel for the license will depend upon how much sales JSW makes, correct? So future sales volume, it depends upon that, market demand, customer behavior. So even though sales occur later, payment is made later. Once the sales occurs, on that 2% will be made by JSW to Tata Steel. The timing difference is not for financing because it's the nature of the transaction itself is like that. Royalty transaction in its nature itself is like that. See, when we talk about customer paying late, customer paying early, it is not in the nature of the transaction. Customer can pay at the point of time itself when the transfer of control of goods or services is happening. Eventually that will lead to performance obligation getting satisfied. Eventually that will lead to revenue recognition. This is what we know. The point is there is a possibility of both happening at the same time, right? But they have personally chosen, okay, to delay it. You understand the point? Here that is not the case. The nature of the transaction is such that you got to wait till the sales needs to happen. After that only you will be getting 2% royalty. So therefore here the timing difference between the payment and the sales and all that stuff, you cannot call that as a significant financing component, right? That is another situation. Third, the difference arises for other reasons and not financing. So what do you mean by that? For example, look at this example. Toyota is a company, obviously, you guys know that. Toyota sells cars to a dealer at 10 lakhs, okay? And dealer withholds 50,000 for quality inspection for 30 days, which means even though you have to pay 10 lakhs, dealer is not paying 10 lakhs. He keeps 50,000 with him and pays 9 lakh 50, and he holds this for a period of 30 days. And after that, if nothing is found, nothing wrong is found in the car, then the balance 50,000 payment will be done to the Toyota. Now the question is there a delay in payment over here? Yes. Time gap exists? Yes. But not because Toyota is financing the dealer. Toyota is allowing the dealer to what? Pay late, and therefore the timing gap, you can call it a significant financing component. No. The reason is dealer is trying to safeguard himself from any future dents or something going wrong with the car that he has received from Toyota. You understand the point? So customer retains money for assurance purposes, safety purposes. So in that case, that timing difference here, in this case it is for 30 days, you cannot call it as a significant financing component. You understand the point? You cannot call it as an interest component. That is third scenario. Last scenario is practical expedient. Practical expedient means many a times Ind AS, when things are getting too complicated, Ind AS gives you an alternative saying that if you don't want your accounting to be complicated, you can just apply practical expedient. Now here also the last point is practical expedient means, okay, all this sounds really complex. Okay, significant financing involved, sometimes it is not involved and stuff like that. You can do one thing. If the timing gap is less than 12 months, then you forget about significant financing. If it is greater than 12 months, then we can think about that. This is what we call practical expedient. That is the last point. So the standard permits entities to ignore financing effects if payment and performance occur within 12 months. If it is greater than 12 months, you don't have a choice, Nana. If it is less than 12 months, you have a choice. Okay. So time gap is less than 12 months, or then there is no need of discounting. Infosys provides cloud services to HDFC Bank, obviously because it's IT company. Invoice issued on 31st March, payment will be made on 30th September, that is 6 months later. Now Infosys has performed now. Are you able to understand? That services is given to HDFC Bank, but HDFC Bank is paying the money later, which means Infosys is financing HDFC Bank, which means Infosys has to charge interest, which means Infosys will get interest income from HDFC Bank. Usually that's the case, but because here it is less than 6 months, you can apply practical expedient. And because the time gap is less than, did I say less than 6 months? Time gap is less than 12 months. It is 6 months, which is less than 1 year. Ind AS 115 allows practical expedient, and as a result, no need of discounting, which means do not talk about or think about the financing component. That's all. Simple. So 4 reasons are pretty simple to remember, Nana. I gave you examples for all the 4. First one is the choice is in the hands of the customer. Got it? The second one is royalty. Nature of transaction itself is like that. There will be a timing gap. And the third case is because of some sort of safety reason or assurance reason, there is a time gap between the providing, transfer of goods or transfer of services versus the payment. And the last point is practical expedient provided by Ind AS 115, where if you want, less than 12 months can be considered as no significant financing component, and greater than 12 months, obviously you can consider significant financing component. Simple, that's all. It is not that important, Nana, honestly speaking, but then still you need to remember, because many times you get confused between certain situations or transactions where you get confused between having significant financing component and not having significant financing component. Therefore, these 4 special cases you got to remember. That's all, nothing else. Let's move on to the next one. Non-cash consideration. What do you mean by non-cash consideration? See, whenever there is a transaction between the customer and the entity, obviously entity provides goods or services. In return, customer gives consideration. Now the question is, that consideration need not be cash in all the cases, in all the scenarios. It can be sometimes in kind. That's what we call non-cash consideration. For example, customer can give shares. Customer also can give something else as well. You understand the point? So therefore, if consideration is not in cash and if it is in kind, then how are you going to measure it? Transaction price. That's the biggest question. Now, if it is cash, means you know the value of the cash, and that's the transaction price. But if it is in kind, there comes a problem. Now, actually, it's a very simple concept, but here also I've seen students getting confused. The reason is, see here, look at this example. PK Limited is the seller. Okay. He sold laptop to SK Limited, who is the customer. All right. Fair value of the laptop is 1,15,000. So logically speaking, once the laptop is given, transfer of control happened, which means PO is satisfied, performance obligation is satisfied, which means revenue can be recognized, provided if SK Limited pays 1,15,000 in cash, then there is no problem. Immediately transfer of control of goods are happened, PO is satisfied, revenue can be recognized. So PK Limited will recognize 1,15,000 as the revenue. Easy peasy. However, customer is not giving cash, consideration in kind. non-cash consideration. So he's giving shares of SK Limited. SK Limited is a customer. His company shares, he is giving it as consideration. In that case, what you have to do? Very simple. Your first preference is SK Limited is the customer. Customer has to pay cash. Now he is paying in kind. Find out the fair value of that kind. In this case, shares. Now, what is the fair value of the shares? That will be the transaction price. Simple. In this case, fair value of the shares is 1,20,000, which means 1,20,000 is your transaction price. That's your first preference. Sometimes, whatever the kind that customer gives, let's say it is unique and you can't find fair value of it in the market. Fair value is nothing but market value, na? Pretty much most of the times. So you can't find market value because the kind of consideration, non-cash, that is in-kind consideration, which is given by the customer to the company is very unique. You can't find fair value for the same. In that case, how to find transaction price? Then simple. Then see what the entity is providing to the customer. In this case, entity is providing laptop. Find out the fair value of the laptop itself. 1,15,000. Then that will be your transaction price. Now here only students get confused. Now please try to understand. See what's happening. Take this example only. I am the entity. You are the customer. I am giving you laptop which is worth 1,15,000. You are giving me shares which is worth 1,20,000. Please try to understand. Here two things are involved. Always the first preference is see what the customer is giving. Uska fair value try to find. Customer is giving shares. Fair value of the shares is how much? 1,20,000. That will be your transaction price. Suppose if this information is not available, whatever customer is giving you, it is really unique. You can't find fair value or market value. Then leave it aside. See what the entity is providing. In this case, it is laptop. Uska fair value how much? 1,50,000. That will be your transaction price. Is that clear? That is the concept over here. That's all. Are we done? Chalo. Moving on. So in the last concept, we have seen where customer is providing you consideration, not in cash, but in kind. In that case, we have seen the first preference will be fair value of the goods that is provided by the customer. If that is not available, fair value of the good provided by the entity will be your second preference. Done and dusted. Moving on to next concept. What is the next concept? Customer provided goods or services. Sir, what is this, sir? Just now you have talked about non-cash consideration where customer will be giving shares or something like that. No. This is totally different. Customer provided goods or services. Sir, what is this? Generally, goods or services will be provided by entity to the customer. Na? Customer will provide only consideration. Na? The job of the customer to give consideration. The job of the entity is to provide goods or services. But here, why customer is providing goods and services? Which means customer is entity. Na? No. Once I tell you the example, you will understand. So for that, let's go to the example. Now look at this example over here. Look at this example, Anna. This is only for the purpose of understanding the concept, okay? PK Limited is the customer, SK Limited is the entity, okay? Customer is giving cloth to the entity. Normally, with tailors, we'll be doing now once upon a time. Now everybody is wearing ready-made clothes. Once upon a time, what we used to do is that we used to go to a garment shop and then we used to buy a cloth. And then we used to take that cloth and go to a tailor. And we used to give that cloth to the tailor and tailor will work upon it and then convert that into a shirt as well as pant and then give it back to us. And that's what we used to wear once upon a time, especially our father's ka jamana, right? But now everybody is going with ready-made unless it is a suit or something like that. So it's similar kind of a scenario, just imagine, okay? So cloth is provided to SK Limited. It's a very costly cloth and in large quantities. Let's say it is 20 lakhs. What SK Limited has to do, convert that into a garment. The value addition that is being done by SK Limited is 9 lakhs. Are you able to understand? And then this 9 lakhs is in return sold to PK Limited for a value of 29 lakhs. Are you able to understand? Now, if you see, this is a perfect example of customer provided goods because customer has provided the cloth upon which SK Limited has worked upon, correct? Now, the point is how to give treatment, how to recognize the transaction price. Well, the answer is very simple. You just see from SK Limited's point of view, that is entity's point of view, whether whatever the goods that the customer has provided, does entity has got control over it or not? Logically speaking, in this case, because it's a cloth, SK Limited will have control. Na? So if SK Limited will have control, then imagine as if this is a separate transaction where SK Limited has purchased it, therefore show it as a expenditure, and then he is selling it with added value of 9 lakhs for 29 lakhs. So SK Limited can show 29 lakhs as revenue and 20 lakhs as expenditure. The net revenue will be 9 lakhs only, logically speaking, if he obtains control. In this case, obviously, he has to obtain control only. That's why I've put tick here. But just imagine only for understanding the concept. Imagine. Okay, even though it is not possible, imagine. SK Limited do not have control of cloth, just like a job work. In that case, you're not getting control now. So all you have to do is that you got a cloth, you don't have control over that. You just need to do the job, convert that into garments and sell it to what? The so-called customer. But doing that job, you are being paid 9 lakhs. In that case, just to show 9 lakhs as revenue. Simple. So if you get control, then sale and purchase. If you don't get control, then only sale. Are you able to understand? Just understand the concept. Okay. Now we'll go for a better example. Let's say Maruti Suzuki company is there. He's the customer. Everybody knows. Real life example I'm giving. This guy wants L&T, okay, to manufacture a plant, to manufacture EVs. He wants to manufacture electric vehicles. He wants to have a new plant in Chennai. So in this process, what happens is L&T is the entity who does the construction job. But to make the construction possible better, I mean, to help or whatever it is, Maruti Suzuki is providing cement to entity, land to L&T, and cranes also is being provided by Maruti Suzuki to L&T. Now, in this case, you need to understand these are the goods provided by the customer who is Maruti Suzuki to the L&T. Now, the question is whether the value of this should be included in the transaction price or not. In this case, it is included in transaction price. Now, 20 lakhs is included in the transaction price. Whether the value is included in transaction price or not depends upon whether L&T has got control over that particular goods provided by the customer or not. So, ask yourself, cement, L&T has got control? Yes. If there is control, then in the transaction price, value of the cement will be included. Land, L&T has got control? No. You just use that land, construct the manufacturing plant and then hand it over to what? Maruti Suzuki only. So you don't have any control. In that case, with respect to land, you will not be including the value of the land in the transaction price. Cranes? No. Cranes belong to Maruti Suzuki. Even let's say operators also belong to Maruti Suzuki. L&T is just using them. So with respect to cranes, with respect to land, L&T has got no control. So you should not be including the value of the land as well as value of usage of cranes in the transaction price. But with respect to cement, L&T has got control. Therefore, to that extent, you can include the value in the transaction price. As simple as that. Here, if you look at this example, because cloth is under the control of SK Limited, the value of the cloth is included in the transaction price. That's why 20 lakhs is added to what? The usual value addition of 9 lakhs, and thereby the revenue became 29 lakhs. Of course, you need to recognize the purchase expenditure as well. But if there is no control, then this 20 lakhs, which is nothing but value of the customer provided goods, should not be added in the transaction price. In that case, your transaction price will be 9 lakhs only. That is the concept. Now, if you can see the example as well here. Just a second now. See here, L&T will build a large plant. Cement is being provided by Maruti, who is the customer. Same example only now, so I'm going straight away. Worth 4 crore, land worth 80 crore. Cranes and Maruti staff operate the cranes. Now evaluate. If the entity obtains control, you can add the fair value of the cement, because cement is usually in the control of L&T only. That's how he can build the construction. So therefore, cement is provided by the customer. Customer provided goods only, but L&T has got control, which means to the extent of fair value of the cement, it will be included in the transaction price. Whereas if the entity does not obtain control, in what cases? Land, no control. Are you able to understand? Even the crane also, L&T does not have any control. In that case, L&T does not own cranes. Maruti staff operate them. Land also, L&T doesn't own it because it is owned by Maruti Suzuki. So you don't have any control. Therefore, in these two cases, whatever the fair value of the land and fair value of the crane should not be included in the transaction price, because L&T has got no control. Therefore, no impact on TP. Did you understand the concept over here? That's what I've explained over here, right? Chalo, let's move on. Next, consideration payable to customer. We are still in step 3 only. I told you step 3 is very big and very important. We are still in step 3. Consideration payable to customer. I have written here very difficult and important. You will understand it. Why is it like that? Right now, we will not be discussing completely, because after that, there are certain special cases. There also this consideration payable to customer will come. Right? Ready? Sometimes you will also pay something back to the customer. Now, this point itself is a little bit weird. Why? Because why would entity pay something to the customer? Because usually what happens is that entity gives goods and services and then customer makes the payment. So this is the usual stuff. So whenever something happens opposite to the usual stuff, it's really weird for us to understand and adjust accordingly. For example, just now we have seen that a customer will provide goods to the entity or service to the entity. So that cloth example we have seen, that Maruti Suzuki as well as what L&T construction example we have seen for EV plant. So those are certain weird situations where customer will provide goods or services to the entity, whereas usually what will happen, entity will provide goods and services to the customer, correct? Same logic here also. Usually customer will pay consideration to the entity, but there are certain special scenarios where entity will pay some sort of consideration to the customer. Sir, what is that, sir? If you look at the examples, cash amounts, some credits or coupons, future discounts for additional purchases, loyalty points, something like that. We'll discuss this in detail. Right now, you guys need to just get the basic idea. All right. Now, in this case, what will be the accounting treatment? Very simple, as per 115. First of all, you as a company, when you are paying something back to the customer, you need to ask yourself, I'm paying something back to the customer na. I'm paying consideration to the customer na. That consideration which I'm paying to the customer, is it for a distinct service or good that customer has given to me? Are you able to understand? For example, let me put it this way. Some big brand is there, Nana. Raymond brand, for example. We'll be seeing this, but anyways, Raymond brand is there. Raymond, say for example, in Reliance Fashion. So they have given their clothes, garments. Okay? Are you able to understand? Let's say Raymond has asked Reliance that you place your garments at the beginning of your showroom on the left side top view, so that any customer who enters your showroom, okay, so they should be in a position to see that. That's what we call it as slotting fee. So that is different. Here, if you see, Reliance Fashions is the customer, Raymond is the entity. You understand the point? Now what is happening? Because Reliance Fashion will keep the Raymond garments in a specific location, which we call it a slotting fee, which we'll see it later. Who has to pay money to whom? Raymond has to pay money to Reliance, because Raymond is the entity, Reliance is the customer, logically speaking. But because customer has given a small preference of a preferable slotting area in the entire showroom, therefore Raymond is paying. So basically here what's happening, Reliance is the customer. Usually for the garments, ready-made garments that Raymond has given to the Reliance, Reliance is the customer. Reliance has to make payment to Raymond. That will happen. In addition to that, Raymond also will make some payment to Reliance, because you have asked Reliance to keep your products at a specific location at a premium place, and for that Reliance will not do it for free. So they'll ask you something, they'll charge you something, so where you will be paying to your customer. This is one scenario. But here, distinct service is not getting provided. As a result, whatever the money that Raymond pays to Reliance for that special place in the Reliance Fashion Mart, for example, in that entire place, for that you're paying fee, that will be reduced from the transaction price. This is the treatment. Suppose, same example, same scenario, Raymond is asking Reliance to place a separate LED TV and then advertise Raymond products, Raymond garments inside the Reliance Fashion Mart. Now here what's happening, the customer, who is Reliance, is providing special service, distinct service, which we call it as advertising services to Raymond. In this case, you have to treat it as a separate contract as such. So the question is payment related to distinct good or service received from the customer? Customer is Reliance Fashion Mart, entity is Raymond in our example. If it relates to a distinct good or service, that advertising LED TV, what I'm talking about, then recognize purchase of good and service and record sale to the customer separately. So two transactions you should see it separately. Means Raymond sending those ready-made garments, selling those ready-made garments to Reliance Fashion will be seen as a separate transaction, and Raymond will record sale for the same, because he has sold his garments to what? Reliance Fashion Mart. At the same time, Reliance Fashion Mart has given distinct advertisement service to Raymond. For that, Raymond will make the payment, and that will be shown separately as purchase of advertising service. So record purchase of advertising service separately and record sale of garments separately, because it belongs to distinct service. Are you able to understand? So whatever the consideration that you paid to the customer, that is Raymond has paid to what? Reliance Fashion Mart, belongs to distinct service, that is advertising service. Therefore treat it separately. Suppose it does not relate to any distinct service, like first one, slotting fee, which I was talking about, then you just set it off with the transaction price. That's all. You'll be getting money from Reliance Fashion, because you are selling your garments to Reliance Fashion, and Reliance Fashion has just kept it at a prominent place, which we call it a slotting fee. And Reliance has to pay the money for all the garments that they have purchased from you, correct? They will just set it off that slotting fee, and then balance will be paid over. So you just need to reduce the transaction rates. That's all. You need not recognize that as a separate transaction. Clear? Of course. In between, there is one more point. What is that? Sometimes, if it relates to a distinct good or service, but consideration is not on par with fair value, they are trying to manipulate. In that case, what you will do? You will just reduce that, whatever the manipulation that they have done. For example, see this example, you will understand the manipulation. Already I gave you example for distinct good or service, which is separate advertising LED TV, and I gave you example for not a distinct good or service, which is slotting fee, which we'll see again. For this, I'll give you example. That is nothing but this one. See, PK is the customer, SK is the entity. Okay. PK has purchased a product A from SK. SK has paid 800. Alright. SK also has sold product B to PK and PK pays 1000. Alright. Now, what is the situation over here? Sorry for that, the error mark was wrong. Now I've rectified it. Now, look at this situation. Presuming that whatever the price at which product A, okay, is sold by PK to SK, for which SK has paid 800, let's presume that it is SSP, standalone selling price, so which is a fair value. So there is no manipulation. Same 1000 is also, there is no manipulation. And presume that this belongs to a distinct good, because distinct good is being sold by the customer to the entity. In that case, if the distinct good or service condition is satisfied, what you will do? Both the transactions you will show separately. We need to think from entity's point of view. So because this is a distinct good, entity will show the purchase separately, 800. And this sale transaction will be shown separately. Therefore, here customer has purchased product B from entity for 1000 rupees. That will be shown separately as a sale. This is what we have understood. So if it belongs to distinct good or service, recognize purchase of good or service separately, sale separately, purchase separately, sale separately. Clear? Now, we are talking about this example where there is a manipulation in the price. Look at this. Same example only, which I picked from here, but the price of product A has been sold by customer to entity for 900, which is a manipulated price, which means it has been inflated by 100. Similarly, SK Limited has sold to PK Limited a price of product B, which is at 1100, which is again manipulated, which means both these guys have got understanding. I'll sell to you at a higher price by 100. You also sell to me at higher price by 100. You will inflate your revenue. I'll inflate my revenue. Both our books will be inflated, manipulated, and people will see that, oh, you have done really good sales. You understand the point? 115 says, obviously, I caught you guys. You can't do fraud with me. So thereby, that 900 you can't show. 1100 you can't show. You should show it at SSP only. That is fair price. Purchase and sale inflated by 100, reduce it by 100. That's what we have seen in the second point. It relates to a distinct good or service. Of course, it's a continuation example. So therefore, this is distinct good in both the cases. However, consideration is greater than fair value, inflated by 100 in this case. Then the excess amount is treated as reduction from the transaction price. That is what we have done here. Clear? Logically speaking, we have seen examples for all the three, but then still we'll continue the same discussion. See, common examples for consideration paid or payable to customer. First one is slotting fee, then we have price protection, then we have cooperative advertising arrangements. These things are specifically discussed as examples for consideration payable to the customer because based on this questions are asked. Now from this we are not going to learn, obviously we're going to go with examples. So look at this examples, Nana. Examples for consideration payable to customer. Ready? Look at this, Nana, same stuff. So we have few examples: promotions, coupons, slotting fee, advertisement reimbursement, cashback. The only question is, does the payment to the customer relates to distinct good or service? If it is yes, treat two separate transactions, one as a purchase transaction, the other one as a sale transaction. Otherwise, reduce it from the transaction price. So look at the examples over here. Suppose Colgate sells toothpaste to Big Bazaar. Okay. Now, Colgate pays 20 lakhs to place toothpaste on a particular shelf. Placing toothpaste on a particular shelf means it is like a slotting fee. So therefore, it comes under slotting fee, which means there is no distinct service, only to promote Colgate sales. Therefore, whatever the payment that you pay to Big Bazaar, because Big Bazaar is the customer, Colgate is the entity. So you are paying consideration to customer, but that is not for a distinct service. It is just for mere promotion. Therefore, the net effect will be there is no distinct service, reduce from TP. Got the point? So therefore, this 20 lakhs will be minus, in the sense it will be reduced from the transaction price, whatever the transaction price it is. Look at the next example. Samsung sells TVs to Reliance Digital. I have taken all the real life examples only, okay, at 2 lakhs each. All right, Samsung is the entity, Reliance Digital is the customer. In the contract, there is a clause. What is that clause? If selling price gets reduced by 50,000 in future, within 60 days of this particular transaction, then Samsung shall refund 50,000 to Reliance Digital. See, this is like a price protection, Nana. Simple logic. See, Samsung has sold TVs to Reliance Digital for 2 lakhs. And after 1 month, Samsung is reducing the prices of all the TVs because of whatever the reasons. Okay. And then Samsung is directly selling at 1,50,000. Then what will happen to your Reliance Digital? He'll be in a very worse situation. Thereby, generally, these kind of transactions, especially B2B, this is B2B, business to business transaction, they will always have a clause of price protection. Price protection means suppose in future Samsung suddenly reduces the prices within 6 months. In this example, it can be, sorry, within 60 days. It can be any timeline. It can be 3 months, it can be 6 months. In this example, I've taken it as 60 days. Then Samsung, the entity, has to pay compensation to the Reliance Digital, that is the customer. In this case, he has to refund 50,000. Now tell me, is there any new service happening here? No. But the same service only, it is a kind of price protection. So therefore, there is no distinct service. If there is no distinct service, means you need to reduce from the transaction price. That will be your treatment. So which means we have discussed this as well as this. Okay. Next, look at the last example. Nestle pays 10 lakh to DMart to run Maggie ads in LED panels inside DMart. This example already I told you from the perspective of Raymond and Reliance Fashion Mart. Same stuff only. So now DMart place Maggie ads inside the LED panel inside DMart. Now that's an advertising, na? It's a distinct service. So when there is a distinct service, whatever Nestle pays to DMart, because Nestle is the entity, DMart is the customer, whatever it pays, it will be considered as a purchase cost or advertising expenditure. So separate transaction. And whatever DMart pays to Nestle for all the Maggie that DMart has purchased from Nestle or any other Nestle products for that matter, that will be treated as separate transaction, separate sale transaction. So cooperative ads, distinct service, therefore purchase cost and TP will remain untouched, which means you will not reduce it from TP. That's what I mean to say. Purchase cost will be dealt with separately, separate transaction, it will be debited, sale will be debited separately. That's what we have done here as well. Purchase separate, sale separate, because distinct good or services. So all the three I've covered with real examples. Are we done? I've given few more examples also. If you want, you can see. We can just go through this as well. Now, you guys want to go? Yeah. See here. Alan Solly is the entity. Shopper Stop or Lifestyle is the customer. Sale value is 25 lakhs. It has sold its garments. Okay. Now, Shopper Stop is charging entity, that is Alan Solly, for choosing shelves to ensure products receive prominent placement. This is nothing but slotting fee. Amount is 1 lakh. So there is no distinct good or service. Therefore, what you'll do, reduce it from the transaction price. Transaction price is 25 lakhs. This 1 lakh has to be reduced. Reduce it. So the net transaction price will be 24 lakhs. Easy. Next, price protection. PK Limited is manufacturer. SK Limited is retailer. Sale is 15,000. And there will be a clause in the contract where PK promises to SK, that is entity promises to customer, that if the price gets reduced in the next 6 months, in our example, we have seen 60 days. Now here it is 6 months. Then I will reimburse. Here also there is no distinct service. So whatever the price protection that you promise to reimburse, if that happens, you reduce it from the transaction price. That's all. You'll get 14,500. Next, cooperative advertising arrangement. Same Alan Solly and Shopper Stop. It charges, say for example, it puts an LED panel and then Shopper Stop advertises for Alan Solly garments. In that case, it's a separate distinct service. Advertising expenditure 80,000. So therefore, you have to show it separately. Advertising expenditure in this 1 lakh. 1 lakh or 80,000? Okay. Amount is not 80,000. It is 1 lakh. That's okay. It is a distinct service, Nana. Therefore, show the advertising expenses separately, revenue separately. Got the point? All right. Normally, this is what will happen, Nana. There are certain unique situations where this also will happen. Right now, don't confuse yourself. This we will see later. Till here, it's done. Right, chalo. So we have seen two examples for slotting fee, price protection, as well as cooperative advertisement arrangement. Chalo, done. So with this, we are done with step 3, the biggest step as well as the toughest. Now step 4 and step 5 is pretty easy for us. So fatafat, let's look at it. Step 4 is what, Nana? Matching step 2 and step 3. What is step 2? Identifying POs, performance obligation. What is step 3? Identifying the transaction price, finding out what the transaction price is. Now in step 4, what we are going to do is that we're going to match step 2 and step 3. So which means if there are multiple POs and if there is a single transaction price, this single transaction price has to be allocated to multiple POs. That's what we are going to do. Matching step 2 with step 3. Performance obligations with transaction price. That's all. After determining the total transaction price, concentrate on the word total. Okay. We need to allocate it among various performance obligations identified in the contract. If there is only one PO, there is no question of allocation. If there are multiple POs, obviously you got to allocate. How will you allocate? Very simple, in the ratio of SSP, that's all. Look at this example. An entity is selling 3 distinct products A, B and C to a customer at a transaction price of $40,000. Okay. The SSP of the 3 products, for A 20,000, B 12,000, ignore dollars, okay? Just look at the numbers. A 20,000, B 12,000, C 16,000. Total SSP is 48,000. What do you have to do? This 40,000 transaction price should be allocated to A, B and C in the ratio of SSP, which means 40,000 for A into, for A what is the SSP? 20,000 divided by total of SSP is 48,000. For B, it will be 40,000 is the transaction price into 12,000 divided by 48,000. For C, it will be 40,000 is the transaction price into 16,000 divided by 48,000. That's all. Simple. See? You have done with the allocation. That's all. So once you are done with the allocation, that's all. Step 4 is done. Step 4 is all about allocating your transaction price to the multiple POs. That's all. To the multiple POs. There ends the matter. So product A, B and C are distinct performance obligations. The transaction price is less than the total SSP. Yes, total SSP is 48,000, transaction price is 40,000. Obviously, when you are buying multiple products, definitely there will be a bulk discount. Na? We call it as bulk discount or bundle discount, whatever it is. The transaction price is less than standalone selling prices, indicating a discount. As per 115, the discount is allocated proportionately. See, once you allocate transaction price in the ratio of SSP, automatically difference between SSP and allocated transaction price is nothing but discount. Na? Simple logic. Right? So revenue for each product is recognized based on allocated transaction rate. Means now you have allocated this much, 16,667, 10,000, 13,333 for this PO, this PO, this PO. Now you wait for this PO to get completed. PO must be satisfied. Okay, when PO will be satisfied? When there is a transfer of control. When there is a transfer of control. In this case, all the 3 are goods. Na? So transfer of control or goods, then PO is satisfied. Then what will happen eventually? Revenue will be recognized. Simple logic. That is what I called Holy Trinity. I'll show you here as well. Where is it? Just a second, Nana. Here. Control is getting transferred. Then PO is getting satisfied. Why PO is getting satisfied? Because control is transferred. Once PO is getting satisfied, then I'll be recognizing the revenue. So generally people will say once PO is satisfied, recognize the revenue. PO satisfied means automatically control has been transferred. That is the logic. Anyways, you'll understand it once I go to the last step. Chalo. Now the first example is clear right now. Are we done with this slide? Let's move on to the next example. Now look at this. There is a combo of product A and B. Transaction price is 24,000 for both the products A and B. Okay. SSP is given. Then you have total SSP. Since the combo price is lower than SSP, obviously what you will do, allocate the transaction price. These two are 2 POs. So allocate it in the ratio of SSP. So what you will do, 24,000 into 18,000 divided by 30,000. This is 24,000 into 12,000 divided by 30,000. That's what we have done. And the difference is discount. Clear. Okay, nothing much to study. But continuing this example, now this is interesting. Now this you focus. Continuing from previous example, there is a reason behind continuation. See here. SSP of product A is 18,000. Here also 18,000. Product B is 12,000. Here also 12,000. This is small bundle because only 2 products are there. This is big bundle because I'm going to add one more product over here. Okay, product C. Now see what's happening. For this small bundle, the combo price is 24,000. If you add SSP, the total is 30,000, which means there is a discount of 6,000. That's what we have got here. Correct? If you look at the big bundle, after adding product C, the transaction price is 44,000. If you calculate the discount, again the discount is 6,000 only. This is a very important point to note, which means a small bundle of 2 products has got a discount of 6,000, which is A and B. After adding A, B and C also, the discount is still 6,000 for a bigger bundle, which means literally C does not have any discount. That is the logic. For A and B, the discount is 6,000. For A, B and C, if the discount is 6,000, C does not have any discount. Therefore, you should not give any discount to C. If you look at the allocation, look at the allocation, 18,000. Okay, how much is the allocation? 14,400. Earlier also 14,400. This is 9,600. Same stuff. And for C, we did not give any discount C because that 6,000 should be allocated only to A and B. Got the point? So look at the analysis here. Product A, B and C are distinct performance obligations. But the discount on larger bundle, which is A, B and C, is exactly equal to the discount already observable on the smaller bundle, which is 6,000 in both the cases. So then what Ind AS 115 says is that if the discount is entirely attributable to one or more specific performance obligations and the evidence exists from observable standalone bundles, then entire discount is allocated only to those specific performance obligations, which means what you have to understand is that for two products the discount is 6,000. By adding the third product also still the discount is 6,000. Then literally third product has got no discount. So therefore you should not give any discount. That's the logic. Simple. That's all. So discount is allowed only to A and B. C is priced at standalone selling price. So the key point is when a discount on a larger bundle is same as a discount on the smaller bundle, the entire discount is allocated only to the goods in the smaller bundle. Simple. Done? Okay. Now, let's try to understand what is SSP first, because we are discussing about that only. Na? In step 4, we are saying that allocate the total transaction price in the ratio of SSPs. Now, the question is, what do you mean by SSP? If SSP is directly given in the question, then very simple. That's what we call it as observable price of the good or service, where if the entity regularly sells a particular product or service, then obviously you will know its SSP. You got the point. But sometimes SSP will not be available. SSP will not be available means then we need to calculate. Now the question is how to calculate. That is what we're going to see. You can see that we are talking about estimated price of good or service. Here we'll see how to calculate the SSP. But first of all, let's try to understand what is SSP. Standalone selling price is the price at which entity would sell a promised good or service separately to the customer, individually. That's why it is called stand alone. Stand alone, alone, separately, individually, it will be sold to the customer. Either a good or service. Okay. Why SSP is important? Because it's a fair price, as simple as it. It provides an objective basis for allocating the transaction price, ensuring that each PO receives its fair share of total consideration, total transaction price. That's why total transaction price is allocated in the ratio of SSP. Now, how to find SSP? Obvious question. Generally, it will be given in the question. Given in the question is nothing but observable price. That's what we have seen here. Okay. But if it is not given in the question, if it is not directly observable, then we need to calculate. We have to estimate. How to do that? That's where we come to the second point. Estimated price of the good or service. Okay. If the standalone selling price is not directly observable, in other words, it is not directly given in the question, then you need to estimate. Now, how to estimate? For that, we have certain methods. First one, adjusted market assessment approach, expected cost plus margin approach, residual approach. In this, residual approach is important. Okay. Let's start with the first one. Now look at this, Nana. When it comes to adjusted market assessment approach, what happens is that, to put it very simple, you do not have your observable price. So you don't have SSP straight away. It is not given in the question. So now we need to find out. How to find out? Very simple. Look at your competitor's price. That's all. And if your product is exactly identical as your competitor's product, then copy paste the price. That's all. That will be your SSP. Suppose if your product is not identical, but it is similar, which means there are some changes, then adjust for the changes and then have your market price, which is nothing but SSP. That's why it is called adjusted market assessment approach. For example, look at this. TCS, everybody knows TCS. Cloud HR solution is a kind of service that it is offering. Okay. It does not have any SSP, right? So what it does is TCS will observe the price of similar cloud HR solutions offered by the competitors. For example, you can see Oracle, similar kind of a cloud HR service, which is being priced at 45 lakhs. SAP, which is similar kind of cloud HR solution, which is being priced at 50 lakhs, for example. Now, what TCS does is that, okay, fine. When compared to these products, let us see our product is either superior or inferior. It feels that our product is superior when compared to the product offered by Oracle. However, our product is little bit inferior when compared to SAP. Then it means your SSP has to be in between 45 lakhs and 50 lakhs. And that's how it has been priced at 48 lakhs. As simple as that. This is what we call adjusted market assessment approach, when observable price input is not available for SSP calculation. So, evaluate market prices of similar goods or services offered by competitors. It is similar. If it is identical, you'll just copy paste. Generally, it will not be identical. It will be similar, which means with some changes. Adjust for entity specific factors such as brand, quality and geographical advantage. If competitors sell similar software for 5 lakhs and your product is more advanced, probably you can have your SSP more than 5 lakhs. Say for example 5.5 lakhs. When compared to this is a real life example which I gave you. I hope this is clear. So if observable price input or SSP is not readily available, then you will estimate the price of the good or service as the case may be. In that, the first method is adjusted market approach. Got it? You can just remember it as adjusted market approach. It's easy to remember rather than adjusted market assessment approach. I hope this is clear. Chalo, moving on to second one. This is even more simpler. Expected cost plus margin approach. Okay, even that is also not working out. Simply look at your cost, add your profit margin, you get your selling price. That's all. If it cost 8,000 to manufacture and usually your profit margin is 25%, 8,000 plus 25%, that will be your SSP. That's all. Got it? 1/4 of 8,000 is 2,000. Your SSP will be 10,000. Pretty simple. And this is important from problems point of view out of all the three approaches. Okay, important for solving questions. All right, what is this residual approach? Okay, now when it comes to this residual approach, you will not know it straight away. So what I'll do is that let's go to an example. From that we'll try to understand. Look at this example. Okay, I'll write here residual approach. Ready, Nana? Easy only, it's not difficult. An entity sells 4 distinct products A, B, C and D for a total transaction price of 60,000. All right, ignore dollars. The SSP are available for A, B and C but not available for D. All right. So standalone selling price and discounts, it will be given in the question. Okay, 18,900, 18,900, 12,600. But product D SSP is not available. But total transaction price is given, which is 60,000, which means we'll find SSP of product D as a balancing figure. So what we'll do, usually we'll go with the same columns, product, SSP, discount, allocation. You know the SSP and discount. For first 3 products, SSP, discount, SSP, discount, SSP, discount, copy paste. You get your allocation, right? Allocation of TP for first 3 products. You know total transaction price is 60,000. Then automatically this will be calculated as a balancing figure. Got it? So which means as per residual method, your SSP of product D is nothing but total transaction price minus the total of allocation of all the remaining products. As you can see here, 60,000 minus 17,100, 17,100, 11,400, you got the answer. You got it? Chalo, done with this. Now, sometimes there will be a range that will be given for a particular product. Sir, what do you mean by range, sir? See here. Here, for product D, is there any range given? No. So in that case, whatever the balancing figure that you get, that will be the value of D. Value means I'm talking about SSP. Okay. Sometimes for D, range will be given. Look at this example. Continuing from the previous example, you have 4 distinct products A, B, C and D. SSP available for A, B and C. SSP not available for D. Same stuff. Total transaction price is given. How much is that? You have 60,000 and total allocation to A, B and C is 45,600. Same like previous case. Okay. Which means usually what you'll do, 60,000 minus 45,600 balancing figure for residual, for product D. That will be your residual method. You got how much? 14,400. Fine. But there is additional condition given in the question. What is that? The range constraint for product D is given in the question as 12,000 to 22,000. In that case, you need to just check one more condition. Sir, what is the answer that you have got? 14,400. Is it within the range? Yes, which means the answer is correct. If you look at case 2 scenario, the range is given as 12,000 to 22,000, whereas the answer that you have got is 24,400 as balancing figure. So that is outside the range. Therefore, that cannot be called as a SSP. So when there is a range constraint that is given, the ultimate balancing figure that you calculate should be within the range. If it is within the range, it is correct. If it is out of the range, then you cannot use that particular method, which means residual method you cannot use. So look at the conclusion. Residual amount exceeds the observable SSP range, which is 12,000 to 22,000, but you have got 24,000. As per Ind AS 115, residual approach cannot be applied blindly. Allocation to product D must be restricted to its range. Entity must reassess SSP estimation or use another suitable method. 2 more methods are there, na? Adjusted market assessment or expected cost plus margin method. You can use it. But in this case, because it is outside the range, residual approach is not appropriate. So for the purpose of exams, this is the summary. Residual approach can be used only if the resulting allocation, that is balancing figure, lies within the range. If it does not lie within the range, then this method will not apply. You go for the alternative method. Simple. That's all. Are we done? Right. Fantastic. Then there is one more point, that is special variable consideration. What is that? Look at this. Look at this example. Entity is selling 3 distinct products A, B and C at 30,000 to customer. SSPs of all the 3 A, B and C are there. But here comes a special point. Also, there is a variable consideration of 800 on product C, which means this consideration should be given only to product C. So now what you will do, you take this allocation, you allocate to A, B and C in the ratio of SSP, which means you take the transaction price, which is 30,000 into 15,000 divided by the total of this, right? You will do the allocation. Like that you have allocated 12,500, 7,500 plus 10,000. But after that what you need to do is that this variable consideration of 800, because it specifically belongs to C, you should be adding it to C separately, and thereby the allocation of TP for C eventually becomes 10,800 and the total allocated transfer price of all the three products becomes 30,800. This is one new point. All you have to remember is add that separately. That's all. That's what we have discussed here. Allocation of variable consideration. Variable consideration like performance bonus or penalties should be allocated only to that performance obligation to which it specifically relates. In this case, this specifically relates to product C. So therefore, you should add only to product C. Got the point? That's what we have given here, right? Allocation of discount allocation, those things we have already covered. So with this, we are done with step 4. So when it comes to step 4, it's very easy, and all you have to remember is you have to allocate it in the ratio of SSP. SSP will be generally given in the question. If it is not given, you have 3 methods. In that, the first method is adjusted market assessment method. The second method means cost plus profit margin. These two are not that important. The third method, residual approach, is very important. In that case, what you'll do, you'll find it as a balancing figure, and you see whether there is any range constraint. If there is a range constraint, it should fall within the range. Then there is no problem. If it does not fall within the range, then that method will not suit. You have to go for alternative 2 methods. That's the only way you can find SSP. Ultimately, the summary is you need to allocate your transaction price, total transaction price, in the ratio of performance obligations, in the ratio of SSP to the performance obligations that you did find out as a result of step 2. So ultimately, the summary of step 4 is where you try to match step 2 with step 3, where you take the total transaction price, allocate that in the ratio of SSP to all the performance obligations that is available as a result of step 2. Got it? Done. So now we're gonna go for last step, that is recognition of revenue.